By the end of this course, you will understand exactly how institutions read price and how to build a process that is guaranteed to make you profitable. This is a complete beginner futures trading course. Everything I've learned over the years condensed into 3 hours. And it has more value than courses charging you thousands of dollars for the same information. I'm going to show you exactly how I would start trading futures if I had to start from scratch again today, to save you the painful years of being lost. My name is Dylan. I'm a full-time day trader and educator, and I've spent years refining my process and building the exact system I'm going to give you so that you have everything you need to become a profitable trader. And here's the pattern I see over and over again. Traders come to me educated, but not profitable. They've studied the concepts, they've consumed the content, but they have a fractured foundation, no process, no structure, and no clear path forward. And that's what we're fixing in this course. My team and I sat down and we created what every trader wished they had when they started. An A to Z guide, step by step, foundation to execution, everything in one place. I spent years learning what I'm about to teach you in the next 3 hours. I tried every retail strategy under the sun. Support, resistance, trend lines, indicators, you name it. I traded it and I lost my ass in the process. So my goal here is to save you those years, to give you the roadmap I wish I had, to show you exactly what matters and what doesn't, so you can skip the confusion and get right to consistent execution. This course is broken down into 3 sections. Section 1 is the foundation. This is where you're going to learn what trading actually is. You're going to learn why futures are the professional trader's choice, how markets actually work, how price is delivered on a chart, and why technical analysis beats fundamental analysis every single time. By the end of section 1, you'll have the foundation, the building blocks. Everything else will build on this. Section 2, how to read the market. This is where it gets interesting. You're going to learn how smart money traders view price. While others show you how to pattern trade these concepts or dilute it with retail gimmicks, we're going to show you exactly how it all comes together to access the precision that comes with it. You're going to understand liquidity, what it is, why it matters, and how smart money uses it. You're going to learn about imbalances, sessions and kill zones, the market efficiency paradigm, premium and discount pricing, and institutional order flow. This is the stuff that retail traders don't talk about because they don't understand it. But smart money, this is their language, and you're about to learn it. Section 3, execution and process. This is where it all comes together. You're going to learn risk management, how to build a trading model, how to create a trading plan and set goals, how to journal your trades, and how to build structure and routine into your day-to-day. Because knowledge without execution is useless, and execution without a process is just gambling. By the end of this course, you will know exactly what to do day in and day out to become a profitable trader. So let's get into what trading is not. Trading is not fast money. Now, you can make a lot of money. It can become fast money, but early on, it's not the case. So this is not a shortcut. This is not going to just watch the 3-hour-long lecture or however long this ends up being, and you're going to automatically be profitable. This will point you in the right direction. It'll tell you exactly what you need to do if you're serious about this, but there is no shortcut. And this is something I wish someone would have told me. When I first started trading, I did the same thing you guys did, right? Looking at YouTube videos every single day, seeing what the new strategy is, hoping I'm going to find that secret 100% win rate strategy that just makes it easy for me. Now I don't have to learn how to read price. I don't have to manage risk. I don't need a trading plan. I don't need to journal, backtest. Man, screw all that. I'm just going to find a shortcut. It does not exist. If there was a shortcut out there, I would just give it to you. I would make my life easier and yours and tell you what it is, but it does not exist in trading. Everything in this world you're going to have to work for. Trading is no different. This is not signals, right? So if you're trying to copy trade somebody or take somebody else's trade, that may feed you in the short term, but you want to have the skill set. You want to be able to know that you can feed yourself from your own hands with this skill. And that's what's possible if you do the right things. And it's not hype, right? So I'm not going to hype you up like you see all these other videos, my 5-minute breakout strategy, the only one you'll ever need. And then there's 5 more strategies that are the only ones you'll ever need, right? That is marketing to noobs so that the unsuspecting person that says, wow, maybe trading is really this easy. Let me buy this. And you realize that that's not the case. If I can save you the thousands of dollars of getting scammed, that's my goal. So if you're buying into hype, if somebody is trying to sell you hype, get paid out in a month, use this strategy, 100% win rate, just the stuff that you see out there that is too good to be true, it probably is. Because if it's not hard work, if it's not discipline, and it's not doing it over the long run, then it does not exist. And it's probably just someone selling you a pipe dream to fleece your pockets. You have to understand that trading is a professional skill. It requires patience, study, repetition, and doing the same things. If you half-ass this, the market will punish you. So your next steps. From here, you can join the Discord where traders are all studying this material together and they're all in the same pursuit as you to create income from the markets, create financial freedom, and create a better life for themselves and their family. Study the course properly. Take your time, right? You don't want to rush through this. You want to go through the content, really take in what I'm saying. It took me years to learn the things that I'm going to give you in this lecture, and it's my goal to shorten your learning curve as much as I can. Take notes. So you should absolutely have a notepad, maybe an iPad, whatever you're taking notes on, because that's the way your mind's going to retain it. If you're just going to watch it like Netflix, watch it through a 2x speed and not take any notes, well, then you're going to have to live with the results that you're going to get from that. But if you want to do well, you have to take this serious, and that starts with studying the right way. Rewatch sections as your understanding develops. So as you start growing, as you start understanding and getting more experience, and you start rewatching certain sections, you're going to see it's a whole nother video. It's a whole new, fresh perspective now that you've gained more experience. So don't think, okay, I watched it once, it's done. Rewatch certain sections, especially the ones that resonate with you, because you'll see over time, especially as you get more experience, it's going to be like watching a whole new video because now you have more context, more understanding, and it will click on a level that it didn't the first time you watched it. So you can join the Discord. In there, you'll be able to get free pre-market analysis, ask questions of myself and my team as you're working through this course so that we can help you with any questions you may have. And also you can communicate with other like-minded individuals, again, who are on the same mission as you. So let's get into why trading is the best business in the world. There's no boss and there's no employees. So you don't have to worry about your boss telling you when you can have vacation, how long you need to work, how much time you can spend with your family, and how much your time is worth. For my business owners out there, work with several of you guys, no employees, right? Having to worry about a 10-person team. Is everybody doing what they're supposed to be? KPIs, staying on top of them. Is everybody doing what they're supposed to be? Collaborating, working with the entire team. Trading is an individual sport. So you don't have to worry about the bosses. You don't have to worry about the employees. It's simply you in your charts. Now that's a good thing and it's a bad thing. It's a good thing in the sense that it's freedom. You literally will control what you can make and how well you do. But in the other sense, all that discipline now has to come from you. There's no boss saying, if you don't get to work on time, I'm going to fire your ass, right? That fire has to be within you. You have to backtest, you have to journal, and nobody's going to tell you to do it. You have to want it, and you have to be hungry. You have to be hungry for success. And of course, the wonderful things about trading. Location independent. Personally, I live here in Panama. I moved over from Florida. I lived in the United States my entire life. And now I live in Panama starting about a year and a half ago. Live in a beautiful beach resort. Love it. Sunny, tropical weather. The location independence that you have from trading is absolutely amazing. And next, it is performance-based. Performance-based meaning you can earn as much as you want. You just have to know how to perform well. So for my hungry, motivated people out there that want to create a better life for themselves, change their financial future, this is how you can do it. But this is a performance-oriented business, meaning if you perform, you get paid. If you don't, you get smoked. So if you want to be in a business that's very competitive, it's performance-based, trading is the world for you. And lastly, there's unlimited earning potential, right? So you can earn as much as you want. No boss is going to say you're only worth this much an hour, you're only worth this much a week. You can make as much as you want. But it all depends on the work you put in, how much trust you have in what you're doing, and you can absolutely scale this to unlimited earning potential. Now, I don't want you to think you're going to do this in your first month of trading, right? But you can absolutely, with the right skills, right, with the right focus, discipline, doing the right things day in, day out, you can absolutely make a lot of money with this. Financial freedom, independent wealth, whatever you want to do with this is possible. And again, what you have to understand is that this is a professional business. This is not entertainment. This isn't a hobby. This isn't, oh yeah, I kind of like the markets. I think it's interesting. It's cool. Like, no, you have to live and breathe this shit if you want to do well with it, because it's very competitive. You're competing against professionals. And if you treat this like a game, you will absolutely lose your ass. Why most traders go wrong, myself included. So I made all these mistakes and I want to cover it up front so that you guys don't have to go through these mistakes as well. Rush the process. Trying to put a time on when you need to be successful. Who says you need to get profitable in 6 months? What if it takes you 2 years? But now you're able to make as much as you want, whenever you want, and you're never worried about the price tag when you're buying things. If it took you 2 years of struggle to get there, would that be worth it? Absolutely. So stop rushing the process. The more you rush the process, the more you're going to delay it. Because now when you're telling yourself, man, I should be here by now. I need my payout next month, next week, or whatever you have in your mind, you're now making it more likely that you're not going to get that result. But if you just allow yourself to develop, I'm going to do the right things, follow the process, and whenever I get there, and I'm going to have a good time doing it. What you're actually going to see is you're going to set the stage for you to get profitable faster. than if you were trying to rush it like most people are doing. Look for shortcuts, right? So I was the one. I'm just going to keep learning, keep studying. I'm not going to worry about risk management. I'm not going to worry about fixing myself. I'm just going to look for shortcuts. And if I just learn more, I'll never take a loss. If I don't have to worry about fixing myself, don't have to worry about psychology, a trading plan, and I'll just take the easy way out. I did this for years. This doesn't exist. There is no shortcut. There is no easy way. And if there's anything you take away from section 1, I hope it's this, that there's no shortcuts. There's no easy way out. There is no free lunch in this world. Everything you get, you have to earn. Short-term, impulsive thinking instead of long-term. So generally, this is going to stem from the previous 2 points, where if you're rushing the process, if you're looking for shortcuts, you're going to be short-term thinking and you're going to be impulsive. That is a horrible combination in trading. Instead, you want to be long-term oriented and you want to be patient. Short-term impulsive thinking kills accounts and absolutely makes for difficult, tough trading, because you're just going to make a lot of bad decisions. You're going to be in a rush, and all you're going to see is that you're delaying your success. You're just pushing it forward every time you succumb to your short-term impulsive thinking instead of having a long-term focus. I chased money instead of skill. So instead of concerning myself with, okay, what do I need to do to actually make the money? I was just worried about the money. So I'm just chasing profits all the time. If I lose, I'm trying to fix the loss and chase more profits. Whereas what you need to do is focus on the skill instead. Screw the money when you're first starting. The money is not important. You're trying to focus on the skill, the process, and having a repeatable framework that you're using every single day. Once you get to that point, the money is a result of that. So don't think you're just going to chase the money and it's magically going to happen for you. You have to focus on the skill, focus on the process. Then as you do the right things, the money is a derivative of that. So don't focus on the money, focus on the right things. The money will absolutely come. And this is a lesson that took me a long time to learn, and I hope it doesn't take you as long as it took me. And these mistakes here added years onto my journey, tens of thousands of dollars in lost money. And that was before I had money. So that was a lot to me at the time, losing my ass, figuring these things out. So you don't have to learn that way. Trading is not impossible. You can absolutely do this. You can absolutely create an income stream from the markets for yourself, but you can't fall victim to what the 90% do. If you want different, you have to think different. So let me get into what actually changed everything for me. Mindset, process, and my focus. My success did not come from a new indicator. It wasn't a new strategy. It wasn't trying to trade 10 different markets. It wasn't switching around from coach to coach, mentor to mentor. Everything changed when I stopped worried about making money and focused on executing correctly. Once I focused on excellence in my execution, trading became easy, because now it's just show up, follow the process, manage risk. What do my rules say to do? I follow that and it's done. There's no second guessing. There's no questioning, am I doing the right things? Am I trading enough? Should I trade more? All those things are easily fixed once you know what you're doing and why you're doing it. And the biggest paradigm shift was when I changed from focusing on making money to focusing on executing the process to the best of my ability. And once I did that, the money comes in faster than you can count it. I did not get profitable chasing new strategies and chasing secret setups. There is no secret setup. There is no secret new strategy that's out there that's 100% win rate that's going to just make this easy for you. And again, the longer you look for that, the more you're going to delay the actual work that you need to do to make this a reality for you. So one of the biggest mindset shifts I want you to take away from here is you don't trade to make money. You trade to execute well. Money is a byproduct of consistency. You have to be consistent before any money is going to consistently come to you. And before you have any consistency, we're all trying to make money, right? I have no consistency. I haven't shown consistency in a demo account, a prop account, a live account, neither. But I'm going to try to chase these big, huge numbers. And there's no consistency to begin with. You first need to get consistent, even if it's with a little bit, right? Because I also thought when I first started, well, I just have a $5,000 account. But if I had a $25,000 account, now I'll be able to be even more profitable, when I wasn't even profitable with a little bit. So if you can't manage a little bit of money, you're definitely not going to manage a lot of money well. So focus on wherever you're at right now, even if it's trading demo, just getting consistent. Because even if you get consistent with a little bit, that confidence will translate into trading live funds. And this is what all of the losing traders do absolutely wrong. They chase the money. They don't worry about executing well. They don't worry about consistency, and they're just always in a rush. And you don't have to learn that way. And everybody understands this in other areas of life, right? You're not in the gym, lifting, looking at your biceps every single rep. No, you know that you got to show up, right? You got to do the uncomfortable thing. You have to have the habits, the routines. And then over 1 month, 3 months, 6 months, you'll probably start seeing results. You'll probably start getting jacked, right? Well, that doesn't happen right away in the gym, the same way with trading. So every other area of life, you have to put in work. It takes time. It's not instant gratification, but if you do the right things, you'll get the result you want. Trading is no different. So does somebody go to the gym, lift for a month? Wow, I'm not Arnold Schwarzenegger yet. Lifting is a scam. No, right? And you can't do the same thing with trading. You have to look at it like, okay, this is a long-term thing. This is a professional business, right? And I need to do the right things for me to get the results that I want. So what you need to understand is that opportunity exists every single day. The market is not the problem. What you need to focus on is the skills you need to acquire to take advantage of these opportunities. One of the biggest mindset shifts for me was when I realized how much money is simply out there, waiting for you to get the right skills. Instead, though, we're not worried about the skills and we're just rushing trying to chase the money. When you put the money aside and you focus on acquiring the right skills, you're going to see that all that money out there, it's available. It's just waiting for you. It's just waiting for you to get the right mindset and get the right skills. And then you're going to see that it's so abundant. There's not scarcity in this world. There's plenty of money to go around. But what you need is skills. And what you don't have is skills. And that's why you're not able to acquire the money. If you acquire the skills, there's so much money out there. And that's what really helped me get out of that mindset of trying to rush, be impulsive, do all the wrong things, and allowed me to have that perspective shift to there's so much out there waiting for me. All I need to do is get the right skills, become patient, become the person that can attract that money. And then the floodgates open up. So there's so much opportunity, but you have to have the right mindset to allow it to come to you. So now what does this opportunity look like? Well, looking at this chart here, you may not understand what any of this means, and that's fine. We'll cover all this step by step. But what this means is opportunity. Every single day, there's movements in the market. Those movements create opportunities. And what you're going to see is that there's so much abundant opportunity available. You just have to learn how to capitalize on it. All right, so let's get into what this course will teach you, how the markets actually work. So you're going to understand why the markets do what they do, how they perform, and how it's consistent so that you can capitalize on it as well. And you're going to understand how price moves. So price has a very specific logic and structure that it follows when it's being delivered. What to focus on. So I'm going to go into exactly what you need to focus on as it relates to learning how to read price action, how to journal, how to do your stats for TradeZella, and also how to set up your TradingView setup. And what to ignore. There's a lot of noise out there. There's a lot of things in the trading industry, and I'm going to tell you exactly what to ignore so that you know what to focus on. So again, you can save the years that I had to spend figuring out what the noise was. Trading becomes very simple once you understand what to focus on. This course was built by myself and my team with the intention to give you that foundation. Next, we need to get very clear on what trading is and what trading is not. So trading is not gambling. So it's not rolling the dice. It's not risking huge amounts of money. If traders are doing that, they still don't know what they're doing. Professionals do not have to risk a lot to make a lot. They're not having to gamble. They're not having to be stressed out. And it's not like casino time. This is a professional skill. It's managing risk. It's knowing how to use your risk strategically so that when you are risking, you stand to make a good amount. And it's not gambling because we have statistical edge in our favor. So we have statistical probabilities that make what we're looking for more likely, which is the opposite of gambling. Because when you're gambling, the house has the advantage. When you're trading, you can become the house and create your own advantage. It's not fast or easy money. So it's easy money once you learn what you're doing, but it's not going to be fast. And it's not going to be easy at first. And it's not the lottery, right? So a lot of traders come into this thinking, I just need one big trade. I'm going to risk 50% of my account, one big trade, and oh my gosh, this is going to set me up for life. That is not the case. It's not going to work for you, and you can only take a loss at 25% of your account, 50% of your account so many times before you cannot take the next trade because you are crushed. And if you come in with a lottery mindset, the markets will absolutely punish you. It's not guessing. We're not guessing. We know exactly what we're doing. We know exactly what we're looking for. Now, that doesn't mean we're right every time, but we know what we're going to do. We know how we're going to manage it if it works in our favor, and we know exactly what we're going to do if it doesn't work in our favor. So there's absolutely no guesswork. There's no randomness. We know exactly what we're doing and why we're doing it. Most people are approaching trading like a game, right? They don't take it serious. They gamble. They think it's a hobby. They think, oh yeah, I can just open up my charts and make a lot of money, in the Forex lottery. But if you treat this like a game, you will absolutely lose your ass in the process. So let's get into what trading is. Trading is a skill, right? It's a high level skill, just like a doctor, lawyer, engineer, right? Anybody that wants to achieve anything that requires skills that's going to pay you well for those skills, it's going to require time, right? So it's a profession. Any profession has a process, right? You don't just start doing surgery on people in your first day. It takes years of study, years of practice, going through a process. Then on the other side, that doctor can then make those doctor salaries. Same thing as a lawyer, right? The lawyer is practicing in practice cases, right? Like demo trading, which I'll cover what that is in a little bit, right? They're going through school. They're reading old literature. So they're going through what? A process so that they can be successful on the other side. You cannot treat trading differently. Trading is also a high level skill, just like any other high paying profession, and you have to do the right things. And it's defined risk, right? So you're defining your risk. You know how much you're willing to lose, how much you stand to make, and everything is controlled. So trading is not gambling. It's not the fast money. It's defined risk, knowing what you're doing and why you're doing it. And then what you'll see with the defined risk is because risk management is what allows your strategy to work over the long run. And I'll get into much more into risk management later in the lecture. All right. So what are the financial markets? Financial markets are valuations of assets, which in simple terms, the value of things. Everything has value. This pen has value. A laptop has value, right? The gas you pump your car with has value. What you understand, though, is that those values change, right? I'm sure oil isn't the same price as it was when you were born however many years ago, right? Those prices change and they fluctuate. So the markets is the fluctuation or the change in the value of these assets, right? So things change in price. So before anything technical makes sense, you have to understand this at the core what the markets are. And it's just the fluctuation in value of assets. And assets are things of value. Let's get into an example of one that's used every single day. Gas and oil, right? You go pump up your car every week. That price changes constantly, right? Sometimes it's $3, maybe it's $2.80. When my grandparents were younger, it was a quarter, right? So those prices change. Well, if you understand where that change is going to happen, like let's say you understand that oil is going to be worth more in 3 days than it is now. Then let's say it's at $3 and it goes to $3.25, right? That's a change in that asset. Well, that's a change in the price of that asset. Well, what you can do with that, if you understand that it's going to go higher, you can now position yourself to capitalize on it, right? And maybe that's filling up extra oil tanks. So now you have more oil, you bought it at a lower price. And then when it's more expensive, you can sell it and make money off it, right? Very simply put, that's what the markets are. It's a change in value of the asset. And if you know where it's going, you can stand a profit off of that change. All right, and let's go into a company that everybody knows, right? Good old Apple. We all have our Apple phones. They're a real company. They're a cash flowing business and they're valued by the market, right? Meaning Apple has a specific value. So just like oil, the value of this company changes. Sometimes the stock price is $100. Sometimes it goes down to 95. Sometimes it goes to 105, right? So the value of Apple changes. Now, as that valuation is changing, people are either making money or losing money. And that just depends on if you're on the right side of what the move is doing. So let's look at an example here. If you buy Apple stock at $100 because you think it's going to go higher, and then it goes higher to 105 and you just bought one share of Apple stock, you have now made $5 if you sell it at 105. So you bought it at 100, the value increased to 105, you sell it, you've now profited $5 off the increase of the valuation of that stock. Now let's use another example. Let's say you buy Apple stock at $100. You think it's going higher, but it ends up dropping to 95 because the value of the company is reduced. Well, now you lost on that transaction. So now your $100 is now 95. So you lost $5. So that's how trading works. You are expecting it to go somewhere, and then you're taking a position based off where you think it's going, and then you can either profit or lose. And it's the same concept across different assets. So we just talked about oil and gas, something you use every single week to get anywhere. And we talked about a famous US tech company, which is Apple. It's the same concept across different assets, right? So we're going to talk about futures, but there's Forex, there's options, there's stocks, there's commodities. It's the same concept across all the assets. The value of the asset is changing, and it's either going up or it's going down. And that applies to every single market. So now you understand the markets at a basic level. So once you understand that the markets are simply valuations of assets, the next question becomes, how do you actually participate in those markets? In the next video, we're going to walk through the different financial instruments that traders use and why this course focuses on futures, which is the best. Now I want to get into the different financial assets. So we're going to cover futures, but I want you to understand all the different financial markets that exist, because when you're looking for a foundation into the markets, you want to understand context, right? What the different markets are, what's available, why we use futures, and that's what I'm going to cover here in this one. So the first asset class we're going to look at is stocks. Stocks are valuations of companies, which we'll get into here in a moment. The other asset class is options. There's either calls or puts. So what options are is they're leveraged positions on stocks, which I'll cover what that means in a moment. And then we have FX or currency pairs, which is basically the exchange rate from like the dollar to the euro. To transact and change dollars for euros or euros for dollars, there is a exchange rate. That exchange rate fluctuates. Sometimes a euro is worth more dollars, sometimes it's worth less dollars, and that value fluctuates. That's what the Forex market is. And then there's the futures market. NASDAQ, S&P, and the Dow, which is primarily what we focus on, which is the stock indices. But there is a lot of different futures markets. There's commodities, there's grains, there's currency futures. There's a lot of different futures markets. But we're specifically going to focus on stock futures, which is NASDAQ and the S&P 500. So let's get into stocks. Stocks are ownership of a company. It's widely accessible, and it's directional exposure. You need the stock to go in the direction of your trade. And what you're buying is ownership in a company. All these companies, they produce cash flow, right? Like Apple, they make money each month, each year, and that company produces cash flow. So the company has inherent value in and of itself. Companies will allow people to invest in it through shares. So what a company will have is they will have shares of their stock where you can buy a share of that stock and have ownership of the company to an extent. So stocks are buying shares of a company, which gives you some ownership of said company. And next we have options. Options are contracts on stocks. There's a lot of leverage involved. So every option is going to move 100 times what the underlying stock will move. If you're not going to trade options, maybe that doesn't make sense. It doesn't really matter. It's just important to understand what the different asset classes are. In options, there's time sensitivity. So because they are contracts on stocks, they have an expiration date. That expiration date is very important for options. And then that's when you start getting into the Greeks, delta, and everything that goes into the options market. But that's way beyond the scope of what we're talking about here. I just want you to understand what the options market is. And we have FX currencies, right? So it's the relative value between countries' currencies, right? So think of all the different currencies that exist, right? The yen, the pound, the euro, the Australian dollar, Canadian dollar. Well, for these currencies to be transacted, there's an exchange rate, right? Meaning, just for easy numbers, let's say $1 is worth 2 Canadian dollars, right? Well, there's an exchange rate there. That exchange rate can fluctuate and it can change. And now $1 can be worth 1 Canadian dollar, right? And the change in that exchange rate is what you can trade in the FX market. It's a global market, meaning it's traded worldwide and it's highly leveraged. So you can trade a lot of leverage and access a lot of leverage in the currency market, which simply means you can have a little bit of money and leverage it into a lot of money in your positions that you're taking. So for futures, which is primarily what we're going to be focused on, it's a contract on an asset, which is an agreement to buy or sell an asset at a set price. It's highly liquid, meaning there's a lot of people trading these markets. There's a lot of orders, a lot of liquidity coming in and out of these markets, a lot of volume, and that causes it to be a highly liquid market, which is good because you don't want to trade markets that aren't liquid because that means they don't have a lot of transactions coming in. So there's probably going to be more slippage. It's going to be harder to fill your positions because there's just not as many transactions happening. The futures market, that's not a problem because it's highly liquid. There's a lot of volume coming into these markets, and that's not a problem. And lastly, they're regulated, meaning the futures market is regulated. So if you put your money in a CFTC regulated broker, they're not going to run off and disappear like you've seen if you know anything about Forex or these offshore brokers or anything like that. There's no funny business like that in the futures market. So the futures is more professional, it's highly liquid, and it's, in my opinion, the best asset class to trade. And it's safe, it's regulated, and professionals all around the world are trading these markets. So for example, let's say you're trading oil futures. You're not actually trading oil itself, right? You're not actually buying a barrel of oil. You're trading the contracts that represent the fluctuations of the price of oil, right? So let's say the price of gas, it goes up from $3 to $3.25, and you're trading the futures contract on that gas or that oil. Well, you're not actually buying that oil, you're buying that contract, and you can get exposure, or you can be able to capitalize on the fluctuation in that price through the futures contract. So you're not actually trading oil, you're not actually trading the stocks in the NASDAQ or in the S&P 500, you're trading the contracts on that value. So why futures? Liquidity. A lot of liquidity is coming through these markets. You want to trade markets that are highly liquid, meaning they have a lot of volume, a lot of orders coming through, because that means you're going to have no problem getting in, getting out, placing your transactions, and it's indicative of a market that has a lot of orders going through it, and that's what you want. Regulation. Again, these markets are highly regulated, so there's no funny business. Everybody's working with the same price. In Forex, the problem with that is you're trading in individual brokers' liquidity. So if you look at Forex and you look at different data feeds, the candles look different. Some have higher highs, lower lows, and that's because it's not a regulated market. All these brokers have their own price feed that they're trading within. So it's not professional. They can open up the spread so you can have all different prices on the same market, euro versus the dollar, euro versus the pound, and you can see different prices in the wicks and the candles, which we'll cover in a moment, across Forex in different brokers. So that is very unprofessional. That is not a regulated market, and that's why futures is superior. Global professional participation. Professionals all around the world, funds, fund managers, hedge funds, banks, institutions, are all trading in the futures market. So it's global professional participation all around the world. Price delivery is very consistent, and it makes it a great market for you to start learning price action in. So now that you understand the different asset classes and why we focus on futures, the next step is breaking down futures step by step so that you know exactly how they work. So what is a futures contract? It's an agreement tied to a price, right? And it's traded on an exchange, which is the CME or the CBOT, depending on what futures contract you're trading. So it's traded on an exchange that is regulated, and it's an agreement tied to a price. So if you look to buy a futures contract at a specific price, then your agreement is tied to that price. If you sell at a specific price, then the agreement is going to be tied to that specific price. So now if you're buying a futures contract, right, that's tied to a specific price, and that value goes down, as we get closer to that date, you're going to lose money on it, right? Vice versa, if you sell, right, which you can bet on the market going lower, and I'll talk about what that means later, and it does go down, right? Now you've made money on that agreement because you sold it more expensive, and then it lost value, so you can make that money. And I'll cover much more of what it means, because most people just think if you don't know anything about the markets, you can just buy when it's going up, and that you can only make money when markets are going up. That's actually not true. As traders, as speculators, you can make money if the market's going up or down. You just have to know where it's going, and I'll talk much more about that as we proceed. And it's standardized. So everybody is dealing with the same price. We're not having a different price here and this broker has a different price. Everybody is looking at the same price, and they're trading through the CME liquidity. So it's standardized, and it's not changing. It's not different prices like you're going to see in the FX market. So it's very professional. So let's get into expiration, right? So futures contracts have expiration dates. And all that means is that the contract eventually rolls into a new one, right? So contracts don't last forever. They expire every 3 months. Now, there's no reason to complicate anything. It just means every 3 months you have to change to the next contract, and your broker will take care of the rest. So they expire on a schedule, and we talked about that schedule is 3 months. So every 3 months, the contract expires, and then you have to move into the next contract. So let's say we're in the month of March. So now the NQH contract is expiring. Once it expires in March, you then go to the next month contract, which is NQM, which is now the June delivery. So you go NQM 2026, and then you would roll over into the next contract. So every 3 months, the contract changes. That's all you have to do. And then you'll just change into the next contract, and you'll trade exactly the same. So they expire right on schedule. Every single year, it's the same. Every 3 months, you just trade the next contract. So just like I showed you there, let's say it's March of 2026, and that contract expires, and you just go right into the June contract. You get the June, you go right into the September contract. We get to September, then you go right into the December contract. And those are the only months they expire: March, June, September, and December. So let's get into what time these markets are open. So the futures market, specifically stock indices, opens at 6 p.m. Eastern. So every single evening, the market opens at 6 o'clock. This is because Asia is 12 hours ahead. You may be thinking 6 p.m. in the evening. Why would a market open in the evening? Well, you got to think way across the world in Asia, right? The traders that trade on that end, they're just now waking up, right? So this is the Asian session. I'll get into what that means later as well. And then it closes at 5 p.m., Sunday through Friday. So it's open 23 hours, 5 days a week. It opens on Sunday at 6 p.m., and then it closes on Friday at 5 p.m. And in those 5 days, the futures market is open 23 hours, and it only closes for an hour. From 5 o'clock, it closes, 6 o'clock, it opens. So it's only closed for 1 hour, and it's open 23 hours a day, 5 days a week. What you'll learn eventually as well is that not all the times in the day are created equal. There are certain times of the day when we don't expect that much. There are certain times of the day when the market is likely to deliver these explosive runs, and we'll cover all the timing elements as we proceed in this course. So let's break down price movement, right? So we talked about contracts. So what does that even mean? Well, these contracts, they fluctuate in value, right? And they fluctuate in the form of points. So futures move in points. Points are handles. You'll see me using that interchangeably. A point is one handle. One handle is 1 point. Now, each point is broken down into ticks. So for 1 full point, there's 4 ticks that make up 1 point. So 1 point is the fluctuation, right? It moves in points. And then per point, there's 4 ticks in every point. And then that's going to be associated with a dollar value. So let me explain what that means. It's very simple. For the S&P 500 futures, ES, it's $50 a point. So if you buy the S&P at 5,000 and it goes to 5,001 and you bought it and you expect it to go higher and it moves up a point, now that contract is going to add $50 of equity to your account because it moves $50 a point. Now we talked about per tick, 1 point is made up of 4 ticks. So if you do 1250 times 4, that gets you to $50. So the minimum fluctuation in futures is a tick. So the least amount it can move is 1 tick higher or 1 tick lower. Now again, 4 ticks make up 1 full point. For the NASDAQ or the NQ futures, it moves at $20 per point, $5 per tick. And again, there's 4 ticks in 1 point. And you can see 4 times 5 is 20. So there's different contracts and they all have different dollar values, right? So this is the S&P 500. This is the composite, which is basically just the aggregate of the biggest 500 companies in the United States. So those 500 companies are in the Standard & Poor's 500, S&P 500. And what the S&P does is it tracks those stocks and it moves in accordance with them. The NASDAQ or the NQ futures, it is the 100 biggest tech companies in the US. So US tech companies, the biggest 100 are what make up the NQ or the NASDAQ future. So just so you understand what you're trading. So we're trading the stock market in the United States, but more specifically, we're not trading individual stocks. We're trading the overall stock market. The biggest 500 companies are made up in the S&P 500 and the biggest 100 tech companies are made up in the NASDAQ. So let's get into what this looks like in a real example, and we'll get into much more as we proceed forward here. So let's say you're trading the S&P 500 futures. You are buying here, and we'll explain what it means to buy, stop loss, take profit, all that will be covered. But just so you can see an example here. This is the entry where you're going to get in, right? This is where you have a stop loss. And this is where if it hits that level, you're wrong. If you buy here and you're expecting it to go higher, right? Remember, you're buying Apple and you're expecting it to go higher, right? And you're looking for the market to run 10 points higher. Well, now what that looks like is you're risking $250, right? Because it's 5 points. 5 points times 50 is 250. So you're risking $250 to potentially make 500, right? Because 10 times 50 is $500 per contract. So if you trade multiple contracts, now the point multiplier increases. And then looking at an example here, let's say price is at 5,500. Your invalidation level, or where you're wrong, is 5,495. And where you think it's going is you expect S&P to price higher and you think it's going to go to 5,510. If it goes up to that price there, you make $500. If it drops down into your invalidation level, or the 5,495 price, you lose $250. And this is in a nutshell what you're doing in trading. You're predicting where it's going to go. Once you predict where it's likely to go, you now have to get positioned with low risk. And we'll cover much more what that means and how you can do that in the future. So there's micros and there's minis. A mini is a full-size contract, right? So the S&P E-mini S&P 500 futures contract equals $50 a point. So now they've created micro contracts. A micro is 1/10 of the size, and that's going to be seen with MES, the micro E-mini S&P 500. So the E-mini is the big contract. The micro is the small contract. And you can see it moves at 1/10 the size, or $5 a point. So now instead of having to trade the big boy contracts, which are moving $50 a point, you can trade a micro contract, which only moves $5 a point. So micros are 1/10 the size. They help you manage risk properly, and you don't need size to learn. So if you're getting started, or you're demo trading, or you're even considering opening up a broker, you would want to start with the micros, because if you're not consistent with micros, trading the mini, the bigger contract, is not going to be helpful to you. So it's very good for newer developing traders to start in the mini contract so that you can get experience, get skill before you're putting a lot of risk on the table. That will come. You will get really good at doing this. You'll have a lot of confidence with what you're doing, but that part does take time. So I want you to understand the difference between micros and minis. So if you ever see the ES, that's the big contract, If you see MES, that's the micro contract. And it's the same thing for NQ. So NQ is the big contract. MNQ is the micro or the smaller contract. So this is why I recommend starting with micros. It's smaller risk and it's the same market, right? So while the futures contract may be slightly different because the point multiplier is different, it's still the same market and it's the same execution. So you're going to execute the same way on each contract, just like you would as if it's a mini contract or a micro contract. So it just changes the dollar impact, right? And especially early on, you don't want to be risking a lot because when you're learning, you don't want to be stressed out. You want to make the learning process easy for you. You don't want to make it high risk. You don't want to make it stressful, and you don't want to make this harder than it needs to be. So you want to learn with a little bit, learn how to manage a little bit, get profitable with a little bit. Then you can scale that up into bigger money as you get more confidence. And this will allow you to learn without all the unnecessary emotional pressure that most do. And I made the mistake. Experience told me I started trading live funds way too early. And if I could do it all over again, I would not do that. And I would learn the right way like I'm teaching you here. I wouldn't have rushed into live funds, being in a hurry to fund my account, put all the money in it, take a bunch of trades to go absolutely nowhere and blow my account and be in a worse situation than I was before I even started, right? And that stuff's easily avoidable by just not doing the dumb shit. So there's two primary ways to trade, right? You can go long, which is a buy position. So let's say I'm buying the S&P 500 because I think it's going to go higher. A long position is synonymous or the same thing as a buy, right? So if you're going long or you're buying, you're expecting price to go higher, or you're bullish. Bullish is a stance on the market where you expect it to go higher. So if you have a bullish position, you're expecting the market to go higher, then you're going to take a buy or a long position. You can also short sell. This is something that took a while for me to understand because I never understood, well, how can somebody make money on a market going down? Like, how does that even make sense, right? Because we all know you buy stock, right? You buy stock, it goes up, you sell it for more than you bought it, and you make money. Everybody understands that. But how do you make money on the market going down? The easiest way for me to explain it is, let's say you buy the market, right? You think it's going higher and it goes lower. Well, you just lost that money. Well, there's no such thing as money heaven. It doesn't fly away, right? It's transferred into the person that took the other side of your trade. So for you to buy, somebody had to sell it to you, right? So it's always a competition because if someone's buying, someone else is selling. If someone else is selling, somebody has to be buying, right? It takes two counterparties for there to be a transaction. So the easiest way to think about it is if you buy, right, you think Apple stock's going higher and it goes lower and you lose money, that money doesn't just fly away and grow wings and disappear, right? It's being transferred to somebody that was on the opposite side of your trade, which is why this is competitive, right? Because nobody's in here trying to just earn a participation award in trade. They're in here trying to take your money, fleece your pockets. And there's two sides. You can either go long or you can go short, which is a sell. The way a sell works is just like if you're bullish, right? This is a bearish position, which means if you're bearish or you have a bearish stance on a market, you think it's going to go lower. Now, if you think it's going to go lower, you're going to sell that market or short sell it. Now, it's not like you're selling something you already have because you're getting into the position with a sell, right? So if you don't own something and you sell it, right, you're then going to need to buy it back. So the way it works is if you think S&P 500 is at 5,500 and it's going to drop to 5,490, you think it's going to drop 10 points. Well, then you can take a sell position and you can sell it to somebody who wants to buy it. They're going to lose, right, as it drops, and that money's simply going to be transferred over into your account. So that's short selling in a nutshell. You can make money when the market's going down and up. You just have to know what direction it's likely to go. And when you're short selling, you're opening a position with a sell, which basically means you're borrowing an asset you don't have, you're selling it onto the market, and then how do you close out a sell? You have to buy it back. So if it drops, you make money. If you short sell it and you expect it to go lower, it ends up going up. Well, then the person that bought it and took the other side of your trade, they just took that money. So that's a simple way to look at it. So as a trader, right, it doesn't matter if the market's going higher or lower, right? Many people say, well, if the market's going down, everybody must be doing bad. That's not the case, right? Because the markets are zero sum, right? So if somebody's making, somebody's losing their ass. And that's how these markets work. So in summary, why futures, liquidity, transparency, we're all working with the same price, and global professional participation. So you got professionals all around the world trading this asset class because there is nothing better than the futures market. All right, so now that you understand how futures work, the next step is understanding how we analyze the market and how price is displayed on a chart. All right, so let's get into the different ways to analyze markets. So there's two ways to analyze markets. The first is fundamental analysis. what this has to do with is analyzing breaking news, right? So economic news reports that come out, looking at financials of companies, looking at the economics of certain countries. Those are all the things that go into fundamental analysis, and also looking at like statements, balance sheets, looking at company numbers, and also geopolitical events worldwide, right? So if, a certain country is not going to export oil because they're cutting off a relationship with this country, traders and investors are going to use that from a fundamental standpoint to determine where these markets are going to go. So there's two main types of analysis. There's fundamental, which is essentially using economic reports, data, geopolitical events, statements, balance sheets, looking at the company numbers. That's what fundamental analysis is. We don't really use that as much, and I'll get into why going forward. It's not to say it's completely useless, but for what we're trying to do, it's not that helpful at all. Technical analysis is where it's at. What technical analysis is you're analyzing the market through the technicals, through the charts, right? What is the price action showing me? This is going to be much more effective because this is not subjective. It's black and white, and it's easy to know what you're doing. Whereas with fundamental analysis, the problem is it's very subjective. People can look at the same thing and come away with two different conclusions. Now, it's not to say everybody agrees in technical analysis, but if you know what you're doing, it becomes very black and white. When this happens, I do this. If this happens, then I do this. Or if this happens, I do nothing. Technical analysis gives you that. This just gives you a whole bunch of confusion. So fundamental analysis, again, relies on a lot of news, right? So economic news that comes out every month, right? The CPI report, which is inflation, the FOMC, which is the interest rate change, non-farm payroll, which is the employment data, right? This is all fundamental news that's coming out. What fundamental analysis does is they will then look at that news and use that to make an educated prediction on what they expect the valuation of whatever market they're using to trade, right? Whether it's foreign currency, whether it's stocks, whether it's commodities, all those markets are analyzed using these news reports that come out. So I'm not going to get too much into that, but there's reports that come out from all these markets, right? There's reports that come out for oil. There's reports that come out for corn, wheat. There's earnings that come out for these companies that tell you how well the companies are doing, how well they're not doing. And that's essentially what fundamental analysis is looking at. They also look at economic data, right? So economic data is scheduled to come out every single month. We use the economic data in the sense that we want to know when it's coming out, because we understand that when the economic data comes out, that's going to bring a lot of participation into the market and people to want to take trades. We utilize that for our setups. So we're not worried about the data itself, but we want to understand when this data is coming out because it's like a TV guide, right? The moves of the market are scheduled, and it's scheduled based off the economic data that comes out. And I'll teach you how we do use that in the future. Company performance, right? So they'll analyze companies. So like Apple, for example, they'll look at the earnings per share. They'll look at the expected cash flow. They'll look at forward guidance, which basically means the company will just break down what the expectations are for the future. And then fundamental analysts will then take all that information and compile it into, okay, we think Apple's going to be bullish because this, this, and this, and then they're going to take their positions based off of that. Now, for technical analysis, we're simply focused on price, the charts, and past price action, right? So the price is going to be displayed in the charts, and then you're going to look at the past price action to determine what the market is likely to do going forward. That's simply put all technical analysis is you're looking at previous price action to determine what the market is likely to do going forward. The reason this is important is because price represents key levels that the algorithm has used in the past. What algorithm? There is a central algorithm that runs these markets, and it's what makes what we do very precise, very consistent, and very logical. If you don't think there's an algorithm that controls the markets, that's fine. I'm not here to argue. It's just a matter of precision. And if you can trade precisely with your point of view, that's all that matters. What we do works. Nobody can convince me otherwise. So we understand that the market will use past reference points in price action to indicate what it's going to do going forward. So fundamentals explain what already happened, right? They talk about yesterday's news, or the news comes out and it's, oh, well, that was already priced in, or it's just basically justifying what's already happened. You don't make money with what's already happened. You only make money with what's going to happen. Technicals help anticipate what comes next, and our focus is price. So we're stripping everything away. We're not worried about all these economic reports, all the geopolitical changes, all the things that are happening. Now, not that you don't want to be mindful of those things, because you absolutely do have to be aware of the geopolitical climate, things that are happening in the world, but this helps remove the noise. Like I said, fundamental analysis is very subjective, right? Most people look at the same data and they come away with two different conclusions. What are you supposed to do with that, right? With technical analysis, it's very simple. It's black and white. If the market does this, you do this, and we're only focused on price. So it removes a lot of the noise that traders are worried about. So let's look at price. So what is a chart, right? We're looking at a chart here. We're looking at the NASDAQ, and we're looking at a price action chart. The first thing a chart tells you is time. So if you look at the bottom axis here, right, this is time. So you can see it's the 22nd of December. We have 1 a.m., 2 a.m., 3 a.m., 4 a.m., and you can obviously see it's the time, right? So the bottom axis is the time. The axis here to the right is price. So a chart is showing you time and price. So what price is it and what time is it? You're going to see this is all you need. Right now, you're probably too new to understand it, but time and price is literally it. Is it time for the market to move? And what is price telling me it should do? That is it. So a line chart is basic, right? So here we're looking at a chart. We can see the time and then we can see the price. So what this line chart is representing is it's representing what time it is and what price this asset was valued at that time. So it's time on the bottom, price on the left, price on the right, and then you can see the line chart is showing you time and price. Now, candlesticks show more detail, right? And I'll get into what a candlestick is here in a moment. But you can see this is the same price action here on the line chart, but now you're simply seeing it displayed across candlesticks. Candlesticks show more detail, right? So you can see how in the line chart, yes, you can see the time and the price, but now with the candlesticks, you can see details within the price. And we'll cover what those details are in a moment, but just understand that candlesticks show more detail. So we're not looking at charts on a line chart because this isn't all that helpful. So the candlesticks are kind of showing you more information about what's happened during those specific times. So let's get into what a candlestick is. So every candle has to open, right? Because when a new time starts, that time hasn't opened, right? So every candle that you're looking at is going to show you 4 reference points. The first thing is the opening price. That's the first data point you get from every candle. So there's going to be an open, right? So there's going to be a high of the candle. So the highest it's went in that time. So what you're going to see is there's different time frames, right? So we're going to assume we're looking at a 5-minute chart or a 5-minute candle. So what this is showing you is it's showing you the open, the high, the low, and it's showing you the close in this 5 minutes. So it's showing you, let's say it is 9:55. Well, this is going to show you the opening price at 9:55. It's going to show you the closing price at 10 o'clock. And it's going to show you the highest high and the lowest low that it traveled in that 5-minute period. That's what a candlestick is showing you. So a candlestick will show you 4 data points: the open, the high, the low, and the closing price. That's a bullish candle. A bullish candle closes above the open. So there's 2 types of candles. There's an up candle and there's a down candle. An up candle closes above the open. So it opened and it closed higher than it opened. A bearish candle closes below the open. So it opens, trades lower, and closes less than the price it opened at. That is a bearish candle. And a bearish candle shows you the same thing: the open, the highest high, the lowest low, and the closing price. So a candle is only showing you 4 reference points. This is all you need. You don't need anything else. All you need to understand is the open, high, low, and close, and looking at it on a candlestick chart. And all you need to understand is what time it is. And when you blend those things together, reading price action becomes very, very simple. All right, so next we're going to get into the TradingView setup guide so that we can start getting into technical analysis. So now if you understand charts and candlesticks, you're no longer guessing what you're looking at. Next, we'll set up your TradingView so you can follow along with the rest of the course step by step. So let's get into the TradingView setup. First things first is why TradingView? It's the industry standard, so it's a really good charting platform. Just about many traders use it, and it's considered the industry standard. Really, really good charting platform. None better. It's very easy to follow along with, so you're going to be able to follow along with me, my team, everybody else that's working with me, and many other traders out there use TradingView. So if you get comfortable with TradingView, you know how to use it. It, in my opinion, is one of the best charting platforms there is. It's easy to use, it's streamlined, and it gives you all the tools you need. And I'll show you more as to how I have my charts, how I have everything set up, but we'll cover that in later videos. And it has a super clean interface. In my opinion, there is no charting platform cleaner than TradingView. It's easy to use. The tools are great. You can trade through it. TradingView is just absolutely superior. Most of your time is going to be spent looking at charts. So you want to get very comfortable with TradingView. You want to get comfortable using it, using the tools, and you just want to get comfortable looking at charts. Because as a trader, as I said before, This is a lifestyle. This is not a hobby. This is something you need to put a lot of time into. So you want to get very, very comfortable on the charts. All right, so let's get into the different TradingView plans. There's the free and then there's paid. Paid is optional at this stage. If you're just getting started, the free version is enough. You might have ads that might not give you a lot of flexibility to have a lot of different layouts or indicators or whatever. That's not really important right now, especially if you're just starting. The free version is more than enough. Over time, as you start using TradingView more, you start getting more organized. You want to have different templates, different layouts. You want to have more windows open inside of the chart that you're looking at. All that can be done with the paid version, which is optional. So if you're going to get started, the essential one would be enough to get started. I personally use the premium one. I purchase it when it's 70% off on Black Friday. So it comes out to like $600-700 for the full year. But I'm usually able to get it for myself and my entire team. I usually get it for about $250 on the 70% off sale. So be mindful of Black Friday. Sometimes they have sales throughout the year. So this is the one that I use, but it's because it gives me several charts per tab, gives me several layouts, so I'm able to have everything organized. But again, I didn't start needing this. This was over time as I got more refined, more professional. And over time, you're going to see that, you may be thinking, wow, this is a lot to invest in myself. Eventually, you're going to have to put some skin in the game. You're going to have to invest in yourself if you want to be successful. And in trading is no different, right? So you're going to have to put some skin in the game. You're going to have to invest in yourself to do well. Now, like I said, you don't need a paid plan yet. As you get started, you can even start with just the essentials, just the basics. And then from there, you can see that, okay, I'm going to need more. I want more charts per tab. I want more layouts, watch lists, whatever the case may be. And then from there, you can upgrade as you go forward. But it's not essential. And if you do decide to go with a paid plan and you're going to take the leap and use TradingView, you can use the link down below for the best discounts, and it helps out the channel. Thank you. Live futures data. So CME data is required, right? So the markets that we're looking at, the E-mini and the E-mini NASDAQ, so the markets that we're looking at, the E-mini S&P and the E-mini NASDAQ, that price, right, the feed comes through the CME group. So you do need to subscribe through the CME group data. If you don't pay for it and you're using the free version, it's 10 minutes delayed. Now, if you're just starting, that doesn't matter because you're not trading anyway, and looking at the charts 10 minutes in delay isn't a problem. So really, this isn't even something you need until you're ready to start looking at real-time data. So real-time data is going to cost you about $7 per month, and this is a cost you're just going to have to accept if you want access to these markets. Now, if you want markets that are free to access, now that would be Forex, but then you have to deal with all the, Forex shenanigans that come with the unregulated, silly market. So I would recommend the futures market, $7 a month. In my opinion, that's relatively inexpensive to get access to the market. But the cool thing is you don't even need it. You can work with delayed data. It's 10 minutes before, but it's not going to change anything about your study, what you're doing, especially if you're just getting started. All right, so what we're going to be setting up here today in TradingView is first things first is the charts. So I'm going to show you how to set up the charts, how to have it clean. I'm going to show you how to build a watch list. I'm going to show you how to use the different time frames that are available and what that means. I'm going to show you how to use the favorites toolbar so you can have all your favorite tools in one place in the toolbar. And I'm going to show you how to access demo trading. Demo trading is going to be very important for your development as a trader because when you're starting, you don't want to start risking live money. You want to start in practice. You want to demo trade. And what demo trading is where you're trading paper money, where it's still the live market. So you're still going to know if what you're doing is working or it's not. You're just not going to have the emotional pressure that comes with trading live funds too soon. So demo trading, I'll show you how to set that up. And this is going to become your primary workspace. So let's get into it. So here we're looking at TradingView. We're looking at the NASDAQ here. So you can come up. This is how you search a symbol. So here we're using the NASDAQ, which is NQ. And you can see that here. And then here's all the different delivery contract months. If I want to look at the ES, then I would type in ESH2026. And then that's going to pull up the E-mini S&P chart. So that's how you first open the chart. That's how you search ES and NQ. And now how do you get candlesticks displayed? So you may open up TradingView and it may look like this with a line chart. What you're going to do is go up to here and then you can put on candles, right? Because again, you want to see candles. The line is just showing you the price, but the candles are showing you the details within price. So that's how you set up the candles. And mine are just black for down close candles and blue for up close candles. And then if you want to see how I set my candles up, you can see the body is blue. And then it's black here. The borders are all black and the wicks are black. So this is how you would have these candles here if you're interested in having the same color scheme as mine. So this is how you get it. And then the background is just gray. So I have a very light grayish background because if it's bright white, it hurts my eyes looking at the chart so long. So I have it a bit of a grayish color. So the next thing we're going to get into is how to build a watch list. So you're going to click up here in the top right, And here you can see watch list, and then it'll expand. So let me expand it so you can see it better here. Now what this is a watch list. So what the watch list is it has the assets that you're watching in a streamlined place where you can just click and access the different markets. As you see, we have the ESH, NQ, the micro contract, and then the YM. So these are the three stock averages. There's the S&P, there's the NASDAQ, and there's the Dow, which we haven't talked much about the Dow. It's not as important, but just understand that there's three main averages here. And this is how you create a watch list. Now, if you want to add something to your watch list, because you might have whatever TradingView loads for you, you can just go and delete whatever they have with the trash can here. So you can just delete whatever they have, and you can create your own watch list hitting the plus button here. And then it'll say add symbol, and then you can add ESH, whatever asset you're trying to add, and then you would just hit the plus here, and then you'll see it come up in the watch list here, and you can drag and drop wherever you would like it. So that's how you set up the watch list. At first, you only want to have a few, so you don't need to have, like as much as I have here. There's just a lot of things I want to monitor. Really, the ones that I use mainly is just the stock indices here, and then the dollar and certain things that I'm looking at here. But other than that, I'm not looking at the all these markets all day long, all the time. I'm just focused on these markets here. What you're going to learn is you want to be a specialist, right? You don't want to try to trade 35 different markets, because if you can't trade one profitably, you're definitely not going to trade 10 profitably, right? That just goes without being said. So my recommendation is, if you're just starting, focus on one or two markets, right? And if you choose something different than what I'm sharing here, and you want to focus on a different asset class, that's fine, but take my advice. It's going to help you out a lot. Just focus on one thing, get good at it, because all these different markets have different characteristics and different tendencies. So as you learn one market, you're going to get very comfortable and acclimated to that specific market, right? And if you're trying to just trade a lot, you're just going to make this a lot harder than it needs to be. And then that just goes back to what we talked about at the beginning of the course, which is you're just going to add years onto your journey doing the wrong things, trying to focus on too many different things. So trying to save you that pain. This is the watch list. This is how you set it up. You just want to focus on a few things. If you want to see what mine are that I use mostly, again, it's just the ES, the NQ, and the Dow. That's it. All right, so now I want to get into the different time frames. So here you can see we're looking at the 5-minute chart. So what that means is you're looking at the opening price, the closing price, the highest high, and the lowest low in this 5-minute period. So you can see here, this is the 9:30 candle. So from 9:30 to 9:35, you're simply looking at the open, the close, the highest high, and the lowest low. Now, what I want to show you is looking at this here. We're going to put a turquoise rectangle over this candle here, extend it to the left, a little bit to the right. And now we're going to go down into the lower time frame, and you're going to see how the different time frames show the same data differently. So this is a 5-minute chart, meaning each candle represents 5 minutes of time. We're now going to go over to a 1-minute chart here. And now here you can see from 9:30, which would be here, to 9:35, which is here, you now see that same 5-minute candle represented through 1-minute candles. So now each candle on this time frame is 1 minute or 60 seconds. So this is how you move through the time frames. So the 5-minute chart, it's showing you the same data as the 1 minute, except the 1 minute is showing you more detail. So the lower time frames are simply showing you what the higher time frames are doing in more detail. What you're going to learn, you're going to hear this term in trading, is price is fractal. Now, what that means is exactly this here, that the lower time frame is doing exactly what the higher time frame is doing. You're just going to see it represented in a different amount of candles, but it's still going to show you the same data. It's just going to help you refine. And this is the introduction into top-down analysis, where you're going to start your analysis from the higher time frame and work your way down. I'll get into much more of that as we go through this course. All right, so now that we've covered the time frames, the next thing I want to show you is the toolbar here. So you'll see I have this toolbar here with the most commonly used tools that I'm working with. So down here, you'll see the favorites button. Here you can see I can click that, turn it on, turn it off. When you have it on, it's going to have your favorites toolbar. So what I have here is the Fibonacci. So you'll learn what that is here later on. So this is the Fibonacci that is found, which is found here. So here you can see the Fibonacci retracement, put the star next to it. You see now it's off, now it's on, and it's in my favorites toolbar. And the next one you're going to be using, which I use every single day, is the trend line. So the trend line is this one here. And then all this simply is how you draw a line here to the right. If you hold down shift while you're drawing the line, it'll keep it straight for you. If you don't hold down shift, then it'll just go wherever the mouse is. So if you want a straight line, hold down shift and it'll give you a straight line. The other level that we're using here is a horizontal ray, which you can see is this one here. So you click it. This is this one down here. click it, and then it gives you a horizontal ray that's projected forward through price action. So we covered the trend line, the ray. The next one is the vertical line here. So you can see the vertical line. This one will be found here. And then what this just allows you to do is drop a vertical line on the chart. And this is going to be very important when you start doing your back testing and your study and price action, so that you can denote key times of the day, so that you can study repeating characteristics in the market that all form on a scheduled delivery. The other level you're going to be using here is the rectangle. And you can see this one can be found here. Rectangle, select the star, and now you can have a rectangle on your chart. And then what these rectangles help us do is highlight certain ranges. People see rectangles and they immediately think, oh, it must be supply and demand or something else. It's not the case at all. What we're doing with the rectangles is it's simply helping us highlight specific areas in price action that are going to be key. Well, how do you know what areas are key in price action? We'll cover much more of that in section 2. And then the other one here you're going to see is the risk to reward tool. So here you can look at theoretical positions. So this would be like your entry, this would be your stop loss, and this would be your target. So let's say, for example, you thought NASDAQ would rally higher and drop lower. Then you can use the risk to reward tool to help you frame how much your stop is going to be, what your target is, and this is the tool you want to get comfortable with. And then vice versa, you have the opposite tool for long positions, meaning you're expecting it to go higher. Your entry would be here, and then your stop loss and invalidation will be here. And I'll cover much more about stop losses, take profits, entries, how to manage all that. But I just want to show you the different tools that we're going to be using so that you can have them as well. And again, this will all be in your favorites toolbar here. Okay, and then lastly, you may see charts with indicators on them, right? So you may see charts that have RSI, right? Something like this. You might have, other common indicators like MACD, things like this. You want to take all this off your chart. So if any of it comes onto your chart, or you might even have like the volume down here, right? So that would look like most charts are going to have this, and you're going to see the volume here at the bottom. This is completely useless information. So just take it off your charts, keep it clean, because all this is here is a distraction from price, which is what you need to be focused on. So take everything else off your chart, keep it clean, because you want to be able to see what the market is telling you, not what all the other distractions are that are distracting the unprofitable traders. All right, so getting into the trading panel here, you can see on the bottom left, that is your trading panel. When you open that, you're going to see you're going to have a list of options here. Eventually, once you know what you're doing, you've practiced, you have confidence, you can open a broker with one of these companies, deposit your money, and look to trade. What you can do for right now is paper trading. So you can click on this here, and it'll immediately log you into paper trading. So what you can do with paper trading is you can set the balance. So you can go here, account settings, and you can change it to whatever you want. You can add commissions, you can change the leverage, you can do a whole lot of things with this. I'm just going to show you how to set it up so you can start. So let's say you're going to start with a 50K account just for easy numbers. So 50,000, and don't think 50,000 is a huge number. Don't think, oh, well, I don't have $50,000 to put into an account, so I'll never be able to do that. At the end of this course, I'll also show you different ways to access the market, and you can trade a 50K funded account for less than $100. So you don't need a lot of money to make money. You just need skills. So don't worry about the money. Don't think, well, I can't really use this because I don't have $10,000, $20,000 to put into an account. You don't need it. All you need is skill, and the money will find you. Trust me. So you set this here to 50,000. Let's say you're going to practice for a $50,000 funded account, and I'll explain what all that means later. So then you just hit reset. Right? Now it's reset to $50,000 account equity. And then now what you'll see here is on the top left and right, you have your buy and your sell buttons. When you're not logged in, you will not see them in a solid color. They'll be white in the background. When you are logged into a demo account or your broker, you'll see the option to sell and buy. So you can see here you can sell. This puts on a trade for you, and then you can drag the stop loss, the take profit, and all that can be done here. And this is how you can practice and refine your strategy before you start putting real money on the line, because you do not want to learn the hard way, risking money, and find out that you don't know what you're doing and lose a lot in the process. That's not really necessary. So what you want to do is start with demo account, paper trade, and this is how you set that up, and this is how you execute, drag the stop loss, take profit, so that you can start practicing. All right, so we just went over everything you need in TradingView. And again, this is going to be your primary workspace going forward. So you want to get very comfortable with it. You want to use TradingView, fumble around with it. I wasn't perfect on TradingView my first day. I got a lot better as I worked with it. And even those I work with actually taught me a lot about TradingView and different things you can do with it. So TradingView is great. It's where you want to start. And in my mind, you're not going to need anything else in terms of charting or platforms other than TradingView, because all you need is the candlestick, open, high, low, and close, and you just need to be able to see the data on your chart. TradingView does all that for you. So once your platform is set up correctly, learning technical analysis becomes much easier. In the next video, we're going to start looking at price itself and getting into technical analysis. All right, so getting into the charts. Let's keep it simple. A market only does three things. It either goes higher, it goes nowhere, meaning it'll move sideways, or it goes lower. You don't want to complicate it past that. Markets go higher, they go nowhere, or they go lower. So every chart, every strategy, every concept is going to aid in your determination in one of these three things. It's either going higher, it's either going lower, or the market's going to consolidate and move sideways. This makes it really easy because now we have limited options. So you want to keep price simple, right? Price is either bullish and you're expecting it to go higher. It's bearish and you're expecting it to go lower. Or you do nothing because it's not clear, right? And this is also perfectly acceptable either, right? You don't always need to know what the market's going to do, what the next price run is, and you don't need to know every single second what the next move is going to be profitable, right? So you want to get very comfortable early on doing nothing. Most of your time as a trader is going to be doing nothing, waiting, weighing things out, determining, is this a good opportunity? Is it not? Should I trade today? Should I not? All those things are going to be what you're weighing out. So especially early on, you're going to have to get very comfortable doing nothing, which is very hard for a lot of people, but you're hearing it here first. Doing nothing is something you need to get comfortable with. So this is where most traders go wrong when they get into trading, right? They start trading, they want to trade futures, they want to make money in the market, and they start with common retail technical analysis. So here we're going to look at the MACD. This is a very common indicator that's used. Now, all these indicators are doing is it's taking the open, high, low, and close that you can see in the candles, and it's putting them through mathematical formulas that print these lines here. That's all indicator is. So the indicator is basically just torturing and beating the previous price action into submitting into whatever you want the indicator to say. So the indicator is simply reflecting past price action. It's not telling you what the market is actually going to do going forward. So you don't want a chart that looks like this. I guarantee you, especially if you're starting, trying to trade like this, especially when you're starting, is very difficult because there's no rhyme and reason to it. There's no logic. And can somebody make money using this? Sure, but you have to really know what you're doing. You have to have really good risk management because this isn't making the market move. The market doesn't move based off indicators. Can somebody make money with the strategy? I'm sure there's people out there that can, but that doesn't mean it's why the market is moving. So if you're starting, just put this aside. I wasted time with this. It's not helpful. The next common retail mistake is chart patterns, which is simply looking for patterns for the sake of patterns, right? It looks advanced, but it doesn't make the market any clearer for you to read, right? And then all it ends up adding is interpretation and noise. So what retail traders are looking for, what they're trained to look for, is these patterns in price, right? So they'll look for broadening formations, wedges that are ascending, cup and handle patterns. They're looking for double tops, double bottoms. They're looking for ascending triangles, descending triangles. They're looking for head and shoulders, inverted head and shoulders, and they're simply looking for these patterns in price because what they're indoctrinated into thinking, what they're told is that this pattern here is going to tell you what price is going to do. So if you see a double bottom, you should expect it to go higher. If you see a double top, you should expect it to go lower. If you see a descending triangle, you can expect it to go lower, right? So these chart patterns in and of themselves don't tell you anything, right? And what this is it's distraction, it's manipulation from what the market's actually doing, which is in the open, high, low, and close, and what time of day is it. Once you understand that, you can cut all this noise off your trading, and you don't have to distract yourself with what the unprofitable traders are doing. Volume profile. Looks professional. Looks like it's giving you a lot of insight, institutional perspective. Not at all. So what volume profile is trying to show you is it's showing you the volume distributed by price. So how many contracts were traded at certain prices. Again, very similar to indicators. This is just telling you yesterday's news. Who traded this many contracts at this price before? But that has no bearing on what's going to happen in the future. So again, total distraction. It's distracting you from the candlesticks, which is all you need to focus on. And then support and resistance, right? This only works in hindsight. You're not going to see traders trading support and resistance, telling you when it's going to happen, show you their live trades and execute on it because support and resistance is only taught in hindsight, right? Look, oh, look, they use this resistance, it's sold off. So they're going to put this in a book, sell it to you, and you're going to think, hey, look, resistance and support makes the market move. Not at all. And what you're actually going to learn, the way we look at price, we actually attack this because this is flawed logic, and people that are bringing this logic to the market and risking money in it are just offering their money to the market. And again, it only looks clean after the move has already happened. So it's very difficult to actually position off this insight, and it's not that helpful. But you do want to understand it because what you're going to learn is that for somebody to make, somebody has to be losing. So what you're doing is you're having to find where the losing traders are. So if you understand how the prey in this market thinks, you can then be a better predator. Level 2 market data. This is showing you how many transactions are happening at a specific time. And then what some traders will do is they will take the candles and they will look at the level 2 inside those candles. So they'll look at, okay, this many contracts were bought and sold in this candle, and they think it's giving them an institutional perspective, telling them where price is going or not going. Again, if someone's making money with it, awesome. I wish them the best. This does not work though. There's no rhyme and reason to it, and it's not very helpful. Because again, two people can look at the same chart and come away with two completely different conclusions. So that's essentially the problem with retail technical analysis. Now, we're all retail traders because we're not big institutional traders, but we're not retail minded traders. We don't look at the market like a retail trader, right? So we are still retail traders, but the problem with retail technical analysis is they're using indicators, they're using patterns, which is just interpretations of price that are subjective. And those patterns have no bearing on how price is actually going to move anyway. And then one of the questions that I always ask is, do you really think billions of dollars are going to be risked on a shark pattern? Come on now. There's a lot more to it than a bat pattern, broadening formation, support, resistance. There's a lot more to this. Big institutions, deep pockets are not going to risk billions on a whim or on some goofy pattern. That's just not how it works. But it's a perfect excuse for retail to get into a bunch of trades. That's what you need to understand. And then what these tools do is they create false confidence and many times just explain the charts after the fact and not before. So now, back to price action, back to what we focus on. We want to strip everything away, right? Without indicators or patterns and go right back to what price is doing. It's either going higher, it's going lower, or it's going nowhere. All right, so now I want to add structure, right? You strip everything away, you focus on price. Now the repeating characteristics and the structure of how the market is delivered can be clear to you. So price moves in swings, right? Price doesn't just go in one direction, right? If it's going to go higher, it'll run, pull back, consolidate, run, pull back. So the market moves in a direction, right? But it's not just a straight line there. And what you're going to see is that these swings form market structure. So let's get into simple market structure. Bullish market structure is higher highs and higher lows. So you see here, price starts here. It makes a higher high than the previous one, makes a higher low than the previous one. This next high is higher than the previous one. This low here is higher than the previous one. And then you make higher highs. So bullish market structure simply means the market's going to be making higher highs and higher lows. Bearish market structure is lower highs and lower lows. So the price run starts here, it drops, it makes a lower low, makes a lower high than the previous one, breaks again, we have lower lows, retraces, makes a lower high than the previous one, and then we make new lower lows and then lower highs. This is simple bearish market structure. So this isn't a strategy, this is just a simple observation as to how the markets move. If it's bullish, it's going to do this. If it's bearish, it's going to deliver like this. Now from here, I'll show you what this actually looks like in the charts. So you can see here when the market is trending higher, we have a low here, and then we have a higher low here, higher low here, higher low here, higher low here, higher low here. And then we have a higher high each step of the way here, here, and here. Now when a market is bearish, right, it'll make a low that's lower than this one. So now we're making lower lows. This high here is lower than this one, right? So now it's a lower high. We retrace, we make a high that's lower than this one. So now we have lower highs and we're making lower lows. It takes out this low to make a lower low here. So simple bullish market structure, bearish market structure. When you simplify how you see the market, everything else becomes easier. From here, we'll start building the framework that we use to understand price action in section 2. Now, before we get into section 2, if you stayed with it this long, you're already ahead of most traders. Again, most traders are looking for fast money, easy money. They're looking for shortcuts. They're looking for a secret and they're looking to win the lottery. If you've made it this far, it shows you have what it takes. If you're taking notes, really absorbing this, you're doing the right things, and you have what it takes to be successful. And those traders that don't build the proper foundation, they don't study the right things, they wonder why nothing's working for them. And then worse, they may take 10 years to get profitable, and then they'll just think trading's a scam, nobody makes money, but they haven't done the right things to begin with. So everything we talked about here, this is the foundation, right? What are markets? What are the opportunities? How does futures work, right? How do you strip away everything that's going to distract you? How do you just focus on the right things? How do you set up your chart? And how do you focus on simple technical analysis in terms of the market only doing 3 things? This is the foundation, right? So what you've learned so far is designed to give you a good foundation. And now what we're about to go into is going to be the institutional perspective on price. So in the next section, we're going to get into specifically how institutionally minded traders view the market from a perspective of liquidity, imbalance, and time. And this is where things are going to start to click for you. All right, so before we get into this, I want you to keep in mind, you don't need to rush this. Take the foundation you've built, and carry it forward. I'll see you in the next section. All right. So in the first section, we focused on how price is viewed. Section 1 was about simple mechanics, basic market structure, trends, ranges, and all that is necessary, but it's incomplete. To trade well, you need to understand how and why price is delivered. So in this section, we're going to focus on what price is responding to and why most traders are always reacting instead of anticipating. So we're going to cover exactly what the market is doing, how it's delivering, and I'm going to also show you why most traders are reacting. They're not anticipating, they don't know what they're doing, and that's why 95% of traders lose money, because they just have the wrong perspective on the market. They're reacting, they're chasing price, and the way institutionally minded traders view the market is completely different. So most traders are taught to react to price, right? So before I get into what we're doing, I want you to understand what most traders are taught, and maybe you've learned this before coming here. You're being taught how to react to price action. Right? So they wait for confirmation. Confirmation looks like, okay, there's equal highs and the market's running above it. So that is strong resistance that's now broken. So now I want to buy above those highs because the market's going to keep going, right? Buyers are in control. We took out the highs and that's the confirmation they need. You're going to learn that is totally ass backwards. You never want to buy above old highs. Confirmation could also look like, okay, I want to see this market go lower. I'm going to wait for it to drop and then I'm going to chase it and try to go short after there's confirmation. So it's not that confirmation is bad. It's just the way retail traders wait for confirmation is they're just chasing price. They're waiting for the move to happen and then they're trying to do something after the fact, which never works consistently. So they enter after moves have already started. They see it run a little bit and they want to start chasing price action. The difference is institutionally minded traders, traders that really know what they're doing, they predict price. Retail reacts to price. And they place their stops in obvious areas, right? All the books tell retail traders, if there's an old low or equal lows, you put your sell stop there, right? If there's equal highs or one high, singular high, then they're going to put their buy stop there. So traders that are retail minded put their stops in very obvious areas, and you're going to see how this is going to create opportunities for us. So you want to understand the retail perspective because this is what gives validity to what we're doing. So this is how trading is commonly taught. And in the moment, reacting feels safe because, okay, look, it's going higher, so I'll feel confident going in. But what you're going to learn is buying after markets have gone up is the worst thing to do. And selling after markets have gone down is also not a good idea. And again, this reaction mindset constantly puts these traders in late. And that lateness is what the market is designed to take advantage of. So what I want you to take away from this is consistent behavior becomes predictable liquidity. Right? So if their behavior is consistent, they're putting their stops below old lows or equal lows, they're putting their buy stops above a high or equal highs, that consistent behavior becomes predictable liquidity. So you can start knowing where the liquidity is going to be. And as you're going to see, this is a very important concept for what we're doing. So when thousands of traders are all taught the same perspective, they start making similar decisions. And then what you're going to see is those similar decisions create these liquidity pools that we're going to be able to utilize for our trading. So let's get into a little bit more about liquidity. Liquidity clusters around obvious levels. So that might look like this here. Relative equal highs. You just saw in the previous example with retail technical analysis. They have a high here, a high here. Retail sees that as a double top. So they think, okay, it created this pattern here. It's going to drop. Now it's going to go lower. What that does is that creates liquidity here. Because if these traders are betting that the market's going to go lower, they're selling. To protect a sell position, you need to have a buy stop. So they're going to protect that sell position with a buy stop here. The other perspective is if it runs through this high, this is what? Resistance, because it hit it once, resisted, twice, resisted, ran away. And now this is resistance broken. So that must mean the market is bullish. So it's time to buy here. Those are the two ways that buy stops or buy liquidity will form above this market. And it's going to cluster around these obvious levels. And then the market will trade to these specific levels. Now, same thing here. This low here is relative equal to this one, which is the same thing we have here, which is this low relatively equal to this one here, right? So the market will want to seek that liquidity that resides below that low here. And if it's relatively equal, you're going to see this is going to be your best friend going forward. Equal highs and equal lows. And if it's the right time, you're going to see this is a moneymaker every single trading week. And you can see the liquidity that would be at this level here. The market's going to drive into it, retrace, attack the liquidity above this high, and then run for the liquidity below these lows here. I'll get into much more about liquidity, how we use it, but I just want to give you an introduction as to where liquidity forms. Liquidity will be seen in the charts in the form of highs, here and here or here, and in the form of lows. And if they're relatively equal highs or lows, there's going to be even more liquidity at those levels because retail-minded traders trust them. And then now looking at the chart here, you can see a perfect example. We have this low here. You can see it's relatively equal to this one, and it's also relatively equal to this one. So now you can see this is like a support line, which is going to create liquidity, and the market's going to want to draw down into those levels. So we're talking about the institutionally minded perspective, and I want you to understand that before we go into the specifics, because you have to change your mindset if you're going to do well in the market. In these markets, 95% lose and only a few percent win. If you want to crack it into the few percent, you have to be different. You can't think like a sheep. You can't think like the herd if you want to be a predator. So I'm going to teach you how the large traders look at price action, how institutions look at price action, so you can do the same. So large traders cannot react, right? They must enter at strategic locations that allow them to build in their positions over time, right? So institutions trade big size. They can't enter in all at once, and they can't enter at random levels. They need to enter specifically where liquidity resides. That's why liquidity is so important, because the market will run to liquidity to facilitate transactions. Liquidity is the lifeblood of the marketplace. Anything in the market, it's going to revolve around liquidity. And we are trading alongside this order flow, not against it. So I'll get into what this order flow means, but it's basically how the order flows are coming in from large institutions. This order flow, we're trying to trade alongside with it. We're not trying to beat the market makers, beat the institutions. We're trying to trade alongside of it. This is their casino. It's their market. We want to trade in line with these big entities that are moving the market. Now, it's not their buying and selling pressure that's moving the market. It's the fact that they're trading in alignment with it. And the market will trade to these strategic levels for the express purpose of allowing these large institutionally minded traders to fill their positions at strategic levels. So this is why it's very important to understand how they think so that we can trade alongside them. Retail minded traders react. Institutions anticipate and position at strategic levels, right? So this is the huge chasm. Retail minded traders have no idea what they're looking for. They're hoping their pattern's going to form. They're hoping their indicator's going to give them something to work with. So for institutionally minded traders like ourselves, we're anticipating and we're positioning at strategic levels. We're not reacting to whatever the market's doing. So what you need to understand at the core is the market exists to facilitate transactions. They are not designed to make the average investor money. And the reason I bring that up is because, especially, in America, for example, we grew up, right? The stock market. It's there for the average person to put their money in stocks and grow their wealth and their 401k. And the markets are not here for the average investor to make money. The markets are shark-infested waters where people are trying to fleece each other, because what this is, whether you realize it or not, is financial warfare. And if you don't know what you're doing and you don't understand how the markets work, and you just come in here willy-nilly, oh yeah, the markets are great, it's for everybody, and it's, it's here to make me wealth, and, it's here for the average person. It's not at all. And the markets will chew you up and spit you out if you don't come in with the right mindset. So the facade of, oh, the markets are here for everybody and they're here for your participation, they're here for you to do well, that's not the case at all. These markets are here to smoke you. And if you don't know what you're doing, the markets will absolutely expediently take you out. So you want to understand what the market's doing, why it's doing it, and you also want to understand what it's not here to do, right? So the market is simply moving to facilitate transactions. So price is not random, it's moving to where the orders exist. And we'll get much more into that as we proceed forward. So understanding how to look at the chart completely changes your perspective. So you're going to stop chasing moves, you're going to stop guessing, and you're going to start anticipating. And then what you'll switch your focus to is where price is being delivered. And you're going to be anticipating price instead of reacting to it. So you want to stop asking, well, where should I buy and sell? How do I know where to get in? How do I know where to get out? Right? You want to start asking, where is the liquidity in this market? And this is going to reframe how you think about price, because liquidity is going to tell you where the market is likely to go. Now, it's not going to tell you when to trade, when to get in, when it's going to get there, but liquidity tells you where the market's likely to go. And then once you understand this, this is the first skill that you need to develop so that you can have unlimited setups. What do I mean by unlimited setups? Once you know what you're doing, there is no limit to how many opportunities are in this market. But first thing you have to understand is where liquidity is and how the market's likely to draw to it. Once you understand that, that is the first step to having a limitless supply of setups. And you're going to see every concept that we're going to cover going forward is going to build on liquidity. All right, so from here on, going forward, we view price through liquidity, imbalances, and timing. That's it for this course. Where's the liquidity? Where are the imbalances? And is it the right time? So this is the root of how the markets actually operate. Going forward, we're going to build on each of these step by step so that you can have a comprehensive way of looking at price action, predicting it, and eventually get into finding consistent setups. So once you understand that price moves to facilitate transactions, the markets stop feeling random. In the next video, we're going to break down liquidity, what it actually is, and why it drives every meaningful move. So liquidity is simply buy and sell interest in the market, right? So liquidity isn't complicated. It just means orders. Buyers and sellers willing to transact. Without liquidity, the markets can't move, right? So liquidity is everything. Liquidity is the lifeblood of the markets. Large positions require liquidity. So now if you are an institutionally minded fund, bank trader, pension fund, and you're trying to put in your positions, they require large amounts of liquidity. Because remember we talked about at the beginning, everyone that wants to buy needs a counterparty to sell, right? You can't buy something if no one's willing to sell it. Vice versa, you can't sell something if nobody's willing to buy it. So the market will trade to these specific areas of liquidity to facilitate transaction. Liquidity comes from participants placing orders. So all liquidity is participants placing orders. From what you understand now, those orders are clustered at certain levels, but simply put, liquidity is just participants placing orders. Every stop loss is an order. Every breakout entry is an order. So retail participation creates liquidity, and this is completely by design, because if every trader has their liquidity in specific areas, smart traders that know what they're doing can go in and strategically capitalize on that. So liquidity commonly forms around obvious levels, number one of which is the equal highs. So you can see equal highs here. That's a liquidity pool that's going to be a huge magnet for price action. The other is going to be equal lows. So if you have lows that are relatively equal like this or like this here, that's going to be a magnet on price action. Again, as we covered in this example here, relatively equal highs runs up into it. Relatively equal lows runs down into it for the express purpose of taking the liquidity at those levels. And then obviously forms at prior highs and prior lows. So for example, this high here, that is still a liquidity, even though this is still a liquidity pool. Even though it's not equal high or equal low, even singular highs have liquidity above them. So equal highs equals buy stops, where traders are going to have their buy stops, or they're going to buy on a breakout. And the equal lows here are sell stops, or they're selling on a breakout, because the retail-minded trader thinks, okay, we hit once, we hit twice, this is support, this is a good level to buy, so I can trust it. So if it breaks through it, that's going to tell them it's weak, and they're going to want to sell on the breakout. So it's very important to understand how the retail-minded trader views price action, because it's going to be diametrically opposed to what we're looking for. So you're going to see liquidity gives price a reason to move. It gives price a reason to draw to specific levels. And if you look at your charts from this perspective and strip everything away, you're going to start having clarity. So these levels matter because there's liquidity there. The market is not randomly gyrating up and down. An important takeaway that you'll be able to see in any chart you look at, any asset, any time frame. Major price runs are always preceded by a run on liquidity. So we're going to look at this example here, but we'll get into the charts here in a moment. Before every expansion in the market, there will be a run on stops. So the market dropped, cleared the stops in the opposite direction, gives a big price run. Stops taken here, explosive price run. Stops taken here, explosive price run to the downside. Stops taken here, and then we get an explosive price run to the downside. Let's look at it in the charts. So what do we see here? We have a low here, which has stops. Those stops are taken, explosive price run. Right? We now have this high here. These stops are taken, explosive price run to the downside. So whenever you see the market take stops, you now should anticipate a significant price move to unfold from that. And this is how you can start positioning and anticipating these price runs, because if you understand that now every major price run will be preceded by a run on liquidity, that now makes your job very easy, because now you know exactly what you're waiting for and how it's going to walk through your crosshairs. And then what you'll see is that this is often referred to as a manipulation. So if the market is bullish and it's likely to go higher, looking at this price run here, this drop lower below the low is a manipulation to get traders short, stop anybody out that's already long, and allow institutionally minded traders to absorb that position. Same thing here. The market's bullish, it's reaching higher. They drop it below the low here. That is manipulation. That its express purpose is to stop anybody out that's long, and again, allow institutionally minded traders to accumulate strategic positions below this low. Same thing on the downside. Before it drops lower, it's likely to run out stops at the high before that next expansion, because that's going to allow institutionally minded traders to position themselves before that next run. And it'll make sure that the losing crowd, the retail traders, are stopped out. What you don't want to say is, oh, look, institutions are looking to take stops, so I'm just not going to place a stop loss. That is foolishness. You have to have a stop loss. You have to know what you're risking. But what you want to do is you have to wait for the stop hunts. Don't be scared of it. Anticipate it. Know what you're doing. So liquidity can either be swept, which looks like this here, which is a high. It trades above it. It sweeps the liquidity and rejects, right? So liquidity sweep is when the market runs above a high for the express purpose of attacking that liquidity and reversing. A liquidity run is when it attacks a low to run beyond it. So this low here was not taken out to take liquidity and run higher, right? It's running the low, meaning it's reaching for something lower than this low here. Whenever you see that, it's going to run it. So there's two ways that the market will use liquidity. It'll either sweep the liquidity, which means it's just going up there to engage the stops, engage the orders, and then reverse. But a liquidity run is when it runs through that level and it's going beyond it to reach for something either below if you're bearish or above if you're bullish. So price moves towards liquidity to facilitate transactions. Again, price is moving to where the orders exist. So again, liquidity gives price a reason to move. So in your trading, when you're looking for setups, when you're looking to take an entry, before any of that matters, you have to have a good idea as to where that market is likely to draw. And it's either going to be a liquidity pool or, as you're about to learn in the next one, an inefficiency. So you want to keep it very simple. And now, whenever you're looking at price action, you're not just clueless anymore. You're looking for these specific elements of price action. So liquidity itself is not a buy or sell signal. So if there's equal highs, that in and of itself isn't telling you to go long. It's just telling you it's likely to go there. How you get in, how you manage the risk, that is completely separate. And that we'll touch on when we get into institutional order flow and the PD arrays so that you can learn how to take entries and how to now get into these price runs to liquidity. So liquidity is your target. Context, timing, and the structure as to how you can actually engage that liquidity comes next. And then we'll layer in those pieces step by step as we go. It tells you where price is likely to go, not what to do yet. So again, liquidity is not telling you what to do. It's just giving you indication as to where the market can likely draw to. There are ways you can use liquidity as an entry, but that's something we'll talk about when we get into the turtle soup. So your job right now is to identify where liquidity exists before thinking about entries, right? This is the first real skill, right? Before models, execution, risk management, before any of that matters, you have to be able to get good at determining where the market is going. This is the first step in doing so. So everything else is going to build off of this, because if you can't determine where the market's going consistently, then it doesn't matter if you have entries. It doesn't matter if you have a trading plan, risk management, all the things we're going to talk about later, because you don't even know where the market's going. So the first skill you need is this, determining where the market's going. Then from there, everything will build off of this. So once you understand where liquidity exists, the next question becomes why price often retraces these specific areas after fast moves. In the next video, we'll talk about imbalances and why the market rebalances these inefficiencies. Every big price move comes after a stop hunt. Every single time. You want to have that in stars in your notes. See you on the next one. All right, so we've already covered what liquidity means, why it's important, and why it's a key part of your analysis every single time you look at a chart on any time frame. The next thing we're going to cover, which is just as important as liquidity, is inefficiencies or imbalances. What imbalance means. An imbalance is an area where price moves too fast to offer efficient delivery. So an imbalance forms when price moves too quickly in one range of price action. When the market does not fully balance a range in price, meaning it offers higher, lower, and then leaves that range, that is an inefficient range if it does not do that. So what an efficient range is a price range that has been traded higher, lower, has left that range. However, if price moves too fast in one direction, you'll see that will create an imbalance, and I'll show you what that means here in a moment. And what that leaves is unfinished business that the market's going to want to come back into, pull into that imbalance, rebalance, and then continue in the direction that it's going to go. So efficient delivery means price is traded higher and lower through an area, meaning it has to have offered both sides, higher and lower. When the market moves higher and lower through an area, it means that buyers and sellers have both equally had the opportunity to transact inside that range. Now, I don't want you to think that the market is fair for everybody to have an equal opportunity. It's fair for the market makers that are delivering price, right? So understanding liquidity and imbalance, it's delivering to these specific levels for the express purpose of these smart money traders using these key levels. The best way to understand it is inefficiencies are very similar to when you're painting a wall, right? When you paint a wall and you have a paint on that roller and then you roll the paint down, as you roll it down, you're going to see porous pockets inside that paint roll. So what are you going to do? You're going to want to roll back up over it so that those porous pockets in the paint, when it was delivered lower, can be filled in, right? So price action is the same way. It wants to deliver lower, higher, efficiently deliver the range or efficiently apply the paint, then that range is efficiently balanced or an efficiently delivered range. So what you want to notice is the difference between efficient ranges and inefficient ranges, and those inefficient ranges are going to be very helpful in your analysis, very similar to how we've been using liquidity. So let's get into the charts and see what this looks like. So how inefficiency forms. One-sided price action creates inefficiency. So we see here, the market ran higher, cleared the highs, and then we see a big displacement in price action, which simply means a big price run from where it was to where it went to. In that big one-sided run here, we can see that the previous candle before it opened, traded lower, then higher. So this range is efficiently delivered. But then this candle's low, starting this expansion, the market is just one-sided down here. And then you see on the very next candle, the candle opens, trades higher, lower, efficiently delivering that range. So what part is inefficient? From this candle's low to this candle's high here. That creates the inefficiency seen by the gray rectangle. And you can see this was a sudden one-sided displacement that creates an inefficiency. So you can see how the market will want to draw back into these inefficiencies for the express purpose of delivering efficiently and also offering this price for traders that know what to do with it, which I'm going to teach you in a second. So when the market has just traded one-sided lower like this, it's inefficient. So the market will want to come back up into that range to rebalance it before continuing in the direction that it's going to deliver it. So we talked about now two things that the market runs to. It runs to liquidity and markets seek efficient delivery. So the two things the market's running to is either liquidity or these imbalances where it's going to look to offer efficient delivery. So because this imbalance is one-sided lower, the market's going to want to trade back up into that range to offer efficient delivery. So again, the markets seek efficient delivery. Now, not efficient for you and I, efficient for market makers, efficient for smart money that knows what they're doing, knows what they're looking at in the charts, like I'm teaching you here. So you're going to see that price will often return to these inefficient areas, right? Just like we can see here, there's a little gap here. It drops into it, hits it, right? See a small little gap here, trades down into it, hits it. And the same thing we see here with this large gap, trades up into it, hits it, and trades lower off of it. And then you can see how the market uses these gaps, whether it's bullish or it's bearish, which again, we'll get much into as we proceed forward. So imbalances can be a bullish imbalance, which simply means it's an up close displacement, right? So it's a big move higher that had an up close. That's going to be a bullish imbalance. And you can see that here. This candle's high, this candle's low is just one-sided here inside this price range. That is the bullish imbalance. Here we have a bearish imbalance, which is a down close displacement. So a displacement moving lower. And here we can see we have this candle's low, this candle's high. This range here creates the inefficiency. And you can see in this example, the market trades down into it. In this example, the market trades up into it here. I'm going to teach you much more about what to do with these gaps as we go forward. But for right now, you need to understand the market only moves for two things. Either it's moving to a liquidity pool or it's moving into an inefficiency. That's it. What you're going to see is that liquidity and imbalance work together to move price. So price is moving between liquidity and imbalances. That's it. Everything else people distract themselves with is noise. So what you've just learned is extremely important. If you strip down the market to its core, there are only two reasons price ever moves: liquidity and inefficiency. That's it. There is nothing else driving price. No indicators, no patterns, no news narratives. Everything you will ever see on a chart is moving to either reach liquidity or rebalance inefficiency. Once you truly understand that, the market stops feeling complicated. Now, it's very important to keep in mind that not every imbalance must be rebalanced, right? There's nuance to this. It's not just simply, oh, there's a gap, it has to go there. So not every imbalance must be rebalanced, but generally that's what you're going to look for. Just like every liquidity pool doesn't have to be traded to. What's going to determine when you get good at this is how to know which ones it's likely to draw to. And there's a lot of things that we use to help us determine if the market's going to seek either a liquidity pool or an inefficiency. So it's very important to understand that just because there's a gap on your chart, it doesn't mean it's a guarantee that it has to go there. So context and timing are going to play a big role in determining if it's going to draw to those levels or not. And we'll layer in those next as we proceed forward. So what you want to do is identify sudden one-sided moves, and then you want to study how price trades back into those areas, right? Does it use it as support? Does it trade through it? Those are all things that eventually you're going to see are going to aid in your analysis and determining where this market is going. So this is what's going to train your eye. Again, you're not trying to trade this yet. You're simply learning how the market behaves. The execution will come later and will be easy once you understand what the markets are doing. Now that you understand liquidity and inefficiency, you've learned the only two real reasons the market moves. In the next video, we're going to talk about when these things matter most: sessions and timing. So getting into the timing aspects of the market. Price does not move the same at all times of the day. What you're going to see is that if you look at the full 24-hour period or 23 hours when the market's open, the market delivers differently at different times of the day. What you're going to see is that each time of day has its unique characteristics. So the market's delivering differently depending on the time of the day. A big factor of that is because the volume and the participation is also different at different times of the day. So understanding kind of where you're at and what time of day is going to be extremely important to your trading. Understanding when matters just as much as where it's going, right? So where it's going is the start. But as traders, you also have to understand timing. When is it going to go there? And that's what we're going to talk about here in this session. There are specific times when the market is predisposed to move more. And this is where you want to focus, right? So there's certain times of the day where the market's a lot more quiet. And then there's specific times of the day where the market's moving a whole lot and there's a lot of opportunity. This is where I'm going to teach you to focus. So the market moves in sessions. The first session of the day is Asia. What you need to understand is that different regions participate at different times of the day, right? Asia's on a different time zone, Europe, London's on a different time zone, and then North America or the United States is also on a different time zone as well. After Asia, we have the London session, and then after the London session, we then have the New York session. Now let's get into the session times, and this is all going to be in Eastern time. So on TradingView, you always want your chart to say New York. If it's in your local time, wherever you may be in the world, you're not going to be in sync with the algorithm. Everything runs on New York local time. So just to eliminate all confusion, make sure your TradingView is set to New York local time so that you can follow along with me. The session time for Asian session is 7 p.m. at night to 5 a.m. in the morning. London session is 2 a.m. to 11 a.m. And then the New York session is 9:30 a.m. to 4 p.m. These are the primary windows of global participation when liquidity, volume, and inflows come into the market more than other times of the day. And what you want to note is the overlaps are particularly important. So you can see that from 2 a.m. to 5 a.m., Asia and London overlap. You can see that from 9:30 to 11 a.m., London and New York session overlap. So when you have those overlap windows, those are going to be key times of the day when you're going to see very important price runs throughout the day. So let's get into what a kill zone is. A kill zone is a high volume window within a session. So within these sessions, which can be long, there's high volume times within those sessions when the market's more predisposed to give you specific price runs. You want to focus in on these kill zone windows. So again, kill zones are a period where participation increases, and this is likely going to be a time when the market's going to move with a lot more violence, a lot more speed, which is what we need as traders. As traders, we need movement, so we want to trade when the market is moving. And what you'll notice is outside of these specific time windows, the markets can consolidate, drift, and be much more aimless price action. So let's get into the kill zone times. The Asian session kill zone is from 7 p.m. to 9 p.m. That 2-hour window in the evening is the Asian session kill zone. The London session kill zone is from 2 a.m. to 5 a.m. This is going to be that sweet spot in the London session where you're going to get the best price runs during this time for the Europe session. And then lastly, the New York kill zone is 9:30 to 11 a.m. Now, you can adjust it to 8:30 a.m., but 9:30 a.m. is when the stock market opens, the New York Stock Exchange opens, and generally 9:30 to 11:30 is the best time to focus for stock indices trading, especially 9:30 to 11:30 after that opening bell. You know, at 9:30 CNBC, ding, 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 the market opens, and that's going to be at 9:30, and that's going to be a very high volume time to trade where the market's going to produce a lot of good price runs to work with. So now these times is when the market will use liquidity and inefficiency, right? So it's not enough just to understand liquidity and inefficiency. Now you have to understand what times of the day is the market going to use these levels, right? So not every kill zone is going to produce a trade, but this is when they're going to form for you and when the most meaningful runs are going to occur. Let's get into the price charts here. So time tells you when to expect movement, not what to trade, right? So just because it's New York, that's not going to tell you whether to buy or sell. You just understand that that's when the opportunities are created. So we talked about 9:30 starts the New York kill zone, and look at when the most explosive, fast movement occurs throughout the day, right after 9:30 inside that kill zone. This is what we want to trade here. Now, you can trade all these fluctuations in here. There's opportunities in there to trade. Don't get me wrong. However, you want to trade the fastest, the most violent, the easiest price runs to work with, and that's going to form inside the New York kill zone from 9:30 to 11:30. And then you can see how the market is using the liquidity here. It's using the imbalances, and then it's running to the opposing liquidity pools here at the right time. So liquidity and inefficiency explain why price moves. Kill zone explains when the market is most likely to use them. So now you know why and what the market's going to use, and now more importantly, you know when to look for these specific things. So liquidity is going to show you where price is likely to go. The imbalances will show you where the retracements are likely to happen or where the market can draw to, and time tells you exactly when to look for those things. Keep in mind, very important, not every session or kill zone produces a trade. So just because you're sitting down at New York session, that doesn't mean it has to produce a trade for you. Very important to understand that. Early on, you may think it's trading every day or every time you sit down, you're going to risk money. However, that's not the case, right? Not every session or kill zone is going to produce a trade. And you'll know over time, as you study, you get better, you're going to know what that means and when it's not presenting opportunity and when it is presenting easy opportunity. So some days are slow. Some sessions are going to be quiet, and patience is a big part of professionalism because opportunity is not scarce. There's unlimited opportunity. So you don't have to worry about not trading one day, missing a trade, because there's so much opportunity once you acquire the skills. So you want to study liquidity and inefficiency during high volume times when the market is predisposed to move. This is what you're studying. This is what you're focused on. This is your ticket to financial freedom, replacing your job, creating additional income for yourself, whatever you're trying to do. This is the ticket to do it. So this is where you want your focus to be. This is when your setups are going to form. And strategically, this is exactly where your money is going to be made. And you'll learn to refine this much more over time as you grow as a trader. And this is where your trading opportunities are going to occur. So the opportunities that you're looking for, how do I make money in the markets? This is it. Liquidity, inefficiency, and the right time. All right, so now that you understand liquidity, inefficiency, and timing, you have the full foundation for how price is delivered. In the next video, we'll tie all of this together into one framework, the market efficiency paradigm. All right, so let's get into the market efficiency paradigm. The first skill you must develop as a trader is identifying where price is drawing to. So before you worry about entries or setups, how you're going to trade, the first skill you need is identifying the draw on liquidity. What you want to write down is draw on liquidity is number one. Without the draw on liquidity or being able to know where the market's likely to go, nothing else matters. So the first skill you're developing as a trader is getting good at finding that draw on liquidity. Where is the market likely to draw to? And this is what's going to create the limitless supply setups that you're looking for. So to review, price only moves for two reasons. It's either moving to liquidity or it's moving to an inefficiency. There are no other drivers. Everything in the chart revolves around this. So is price moving higher to reach for liquidity or inefficiency, right? It'll look something like this. There'll be imbalances of above market price, liquidity that is looking to target. Or is it moving lower to reach liquidity or inefficiency? So if the market's bearish, it's either going to attack a liquidity pool or an inefficiency. That's it. So every move is going to be one of these two conditions. Either it's going higher for liquidity or inefficiency, or it's going lower for liquidity or inefficiency. Large players need liquidity to build positions. So I want to get back to the institutional perspective here. Why is liquidity so important? Why do we keep touching on that point? Well, large players, right? Big, deep pockets that are trading in these markets, they require liquidity. So liquidity is going to be the lifeblood of the marketplace. Institutions scale in, they scale out, and they need opposing liquidity to fill their orders. And the market is delivered systematically to make that possible. Now, what do I mean by systematically? There's a system and there's a structure for how price is delivered. But it's not what you may think. It is for the collective that we refer to as smart money, which are institutionally minded traders that are looking at the market through this lens, through this perspective. And the market efficiency paradigm basically states that the market is being efficiently delivered, not for you and I, but for market makers, liquidity providers, or who we refer to as the smart money. So let's get into the market efficiency paradigm. Above old highs, retail buys, and smart money sells. This looks like this here. Retail sees their triple top pattern. They see strong resistance here. So when it trades above it, retail wants to buy that. That's a good buying opportunity for them because they're reacting to price and they're chasing it. Smart money will sell to the buy stops here. So as the retail traders are buying, smart money is selling to their positions, right? Again, every buyer needs a seller, every seller needs a buyer. Now you're understanding how they engineer counterparty. If big traders need to get into a position before it drops, what happens before every big price run? A manipulation against that direction. And it's because this is happening here. Retail's buying that manipulation and smart money's selling into it. This is the market efficiency paradigm 101. Below old lows, retail sells and smart money buys. So here we have relative equal lows or a triple bottom, whatever pattern retail is seeing, and the market drops down below it. Retail will sell that. They're going to think the market's weak, it's going lower, we just broke support, so the market has to go lower. Smart money looks at the opposite. They're going to look to buy in here. So this is going to create a buying opportunity for smart money, and they're going to buy the positions that retail is selling below these lows here. Again, market efficiency paradigm 101. The markets are efficient for smart money. And this is going to be one of the most important mechanics to understand, because now when you're looking at price action, you're no longer just looking at candles and the candles are looking back at you. You're looking at the candles, knowing exactly what you're looking for, and there should be a storyline or a logic to why price is doing what it's going to do. So if the market's going to trade higher, you expect it to trade lower first. Vice versa, if the market's going to trade lower, you expect it to trade higher first. And you're going to see that smart money does not chase price. They let it come to them because they know what they're doing. So the market efficiency paradigm. If price is going lower, it often trades higher first. If price is going to go higher, it's often going to trade lower first. And that is that manipulation that we talked about earlier. And what this allows for is strategic accumulation and distribution, right? Which means smart money has to accumulate positions and they distribute positions at certain levels. That's all going to happen based off this market efficiency paradigm. And this is how the markets are delivered efficiently. So you don't want to buy after price runs highs, right? So after a high is taken out here, this is one of the worst places to buy. And you also don't want to sell after price runs old lows, right? So after these lows here are taken out on this drop, this is one of the worst places to sell because it's more likely to reverse. So cheap and expensive are contextual, right? You don't want to sell a cheap market. Vice versa, you don't want to buy an expensive market, but that's going to be contextual. Contextual depending on if we just traded above old highs, then that's probably not a good place to buy the market. And if we trade below old lows, that's probably not a good place to sell the market. And you're going to see going forward, this will be very obvious in the chart. And this is how you're going to transition and not chase price anymore and start anticipating price. So now let's tie it all together. We have liquidity taken here, right? So the market runs higher, clears out the liquidity here, right? And then we see a displacement. So after this liquidity is taken, we displace and run away from it with an imbalance here, right? We can suspect that the market's likely to trade down to here. Why? Because these lows are relatively equal. So there's a lot of liquidity there. And then when the market drops here and then trades higher, it stopped just short of this low here. So now we have what? Relatively equal lows here. Once those equal lows are engineered, the market retraces to an imbalance. So it's rebalancing the inefficiency. Once it rebalances the inefficiency, you're going to see delivery to opposing liquidity. Now, what does that mean? Well, the market drove higher first. Retail's buying this and smart money is selling it. If smart money sold their position and they're now bearish, how do you close out a short position? You have to buy it back to close it. So however you get into a position, you have to do the opposite to close it. So if you're bearish and you think it's going to go lower, you're either going to sell here above the highs or you can sell into this imbalance here. And then you're going to cover your position or close your position at the opposing liquidity, right? Because we understand that below this low, there's going to be sellers. There's going to be sellers here and there's going to be sellers here. So if we sold here, we need to close it out with the buy. So we're going to buy it back from the willing sellers that are here and here. So the market efficiency paradigm is very simple. The market's going to deliver efficiently for smart money, but you have to throw all the retail garbage out of your mind to look at price untainted, unbrainwashed. 9:30 opens, that's a manipulation. Retail's going to buy that. Smart money will sell it. It'll displace away. It'll retrace into that imbalance for the express purpose of allowing these traders that know it's going to keep going lower, they're going to sell more into here. So once they sell more, the market then drops and trades to the target of the opposing liquidity. This is the market efficiency paradigm 101. If it's going to go lower, it's likely to go higher first as a manipulation. If it's likely to go higher, it's likely to go lower first for a manipulation. So the complete framework is going to be liquidity, inefficiency, and timing. That's it. So once you understand where price is drawing to and how it's delivered, you stop reacting to the market. This is the foundation for everything we do next. And from here, we're going to start applying this framework into more price action principles. That's going to give you more understanding as to what the market is doing and why. To trade correctly, you must know whether price is cheap or expensive. Or the other word you're going to learn is premium and discount. When you want to buy something, right? Let's say you want to buy a new phone. Do you want to buy that phone expensive or do you want to buy that phone cheap? Obviously, you want to buy it at a cheap, discounted price. Right? Same thing, whereas you want to sell something, right? Let's say you bought gold and gold went higher, right? Now you want to sell that gold. Do you want to sell the gold cheaper than you bought it or more expensive than you bought it? You want to sell it more expensive, right? Well, the markets are the same way. I'm going to show you how to define cheap and expensive, which again is synonymous with premium and discount. A premium means it's expensive. A discount means it's discounted or it's cheap. So in this, we're also going to expand on fair value and what that means. A dealing range is the range in which price is currently being dealt, right? So before we can explain premium and discount and what that even means, the first thing you have to understand is what a dealing range is. And a dealing range simply means the range that price is being dealt or the range that we're trading within. So looking at this here, we have a drop lower into this low here, and then we have an impulse run higher. Inside this range, this is the range that we're trading within because this is the lowest low, the highest high. This becomes our dealing range. So a dealing range will form after liquidity is taken, and then you want to identify the impulse move that happens after that liquidity is taken, and that's going to define the dealing range. And this is the range that smart money will use to measure premium and discount so that they can strategically accumulate and distribute their positions. And again, we're learning how the institutionally minded trader views price so that we can trade the same way. So let's get into the checklist. For there to be a dealing range, liquidity has to be taken, right? There has to be an impulse run higher in that direction. And then once you have that impulse run higher and then you create a high and it starts to pull back into the range, that becomes your defined dealing range. Now, once you have this dealing range, you want to split the dealing range in half. Now we have this low to this high. Halfway is here. That midpoint is equilibrium. So this is referred to as our equilibrium price point. So from the range low to the range high, 50% of it is our equilibrium price. Equilibrium is how fair value is measured. So this is not subjective. It's not guesswork. It's very scientific. You get the range, you measure it, you split it in half, and you now have the equilibrium price point. Now, what we do with equilibrium is anything above equilibrium is a premium market or expensive, meaning you don't want to buy it up here when it's in a premium or up here. You want to wait for it to come down below equilibrium to a discount. So when it drops below equilibrium, it's offering price in a discount market below equilibrium. So just like we talked about, if you're trying to buy a new phone or a home or whatever you're trying to get, you don't want to buy premium expensive prices. You want to wait for it to come down into a discount so that you can get a good, cheap price on whatever you're buying relative to where it's going to go. The way we measure this in the market is with a dealing range. So we have equilibrium, we have our premium, and we have our discount. So a premium means price is expensive relative to the range we're in. Discount means price is cheap relative to the range that we're in. So vice versa, if it was the other way around here, we have a range high, range low, equilibrium is here. You don't want to sell in a discount. You want to wait for it to come up into a premium so that you can sell the market expensive. Just like you want to buy it cheap, you want to sell expensive. And this is how fair value is measured. So if you're bullish, if you think the market's going higher, buying in a discount is fair value buying. If you are bearish and you think the market is going lower, anything above equilibrium is selling in a premium. So you're selling an expensive market, which is what you want to do. Smart money accumulates and distributes at these strategic levels of fair value. Because they're not willy-nilly trading, they have to follow very specific rules and procedures when they're trading and determining the range, splitting it up into equilibrium. It's simple, it's measurable, and you're going to see it in your charts every single day. So the main takeaway is you don't want to buy in premium. You don't want to buy markets that are expensive, chasing the market around. And vice versa, you don't want to sell in a discount. You don't want to sell something that's cheap. If you're going to sell it, you want to wait for it to become expensive. And what you're going to see is that most traders actually do the opposite. Most traders are buying in premium and selling in discount. And what smart money is doing, institutions, is they're waiting for strategic levels. They're not impulsive. They're not in a hurry. They're not in a rush. They're very calculated and deliberate with what they're doing. Now, for the optimal trade entry, it is the 62 to 79% retracement. So we talked about equilibrium, 50%. But now there's such thing as an extreme discount or an extreme premium. And I want to show you what that means. And that's going to be the 62 to 79% retracement, or in other words, the optimal trade entry. So what this looks like here, and I'll show you how to do the settings before I get into it. So what you're going to want to do is you're going to want to have the 0 and the 1. And then you're going to want to have the 62% and 79% retracement. And you're going to see that's going to give you this range in price here. Now, the reason this range is key is because we talked about how equilibrium is important. So you understand that this level here is important because it's equilibrium. So anything above that is going to be expensive. However, when it trades in the optimal trade entry, this is going to be very expensive. So this is a very good place to look to sell because it's in a very expensive market. Vice versa, if you are bullish and it drops all the way down to the optimal trade entry, this is a very deep discount or a very cheap market for you to buy. So that 62 to 79% retracement level, that is your optimal trade entry. And it's very similar to what we talked about with the dealing range, except it's just going to be a deeper retracement below equilibrium into a deep discount. And that's what the optimal trade entry refers to. So let's get into how this fits into the overall framework. We talked about liquidity and efficiency, right? The dealing range, measuring that range, which is going to give you premium and discount. And then within premium and discount, you have the optimal trade entry to further help you determine whether a market's very expensive or very cheap. So now that you understand how to define a dealing range and how fair value is measured within it, the next step is learning how price actually uses liquidity inside the range and when it's likely to expand beyond it. That's where internal and external range liquidity comes in, and that's what we'll break down next. So let's break down internal and external range liquidity. There are two types of liquidity. There's internal range liquidity and there's external range liquidity. So liquidity exists both within the range and outside the range. And understanding this is going to be critical for framing price runs going forward. So again, this doesn't have anything to do with entries. This just more has to do with how price moves, because once you understand how price delivers, trading is the easiest thing. So internal range liquidity is liquidity that exists inside the dealing range. So we have our range high, we have our range low. The internal range liquidity is going to be liquidity that's inside the range. So we have this range, look back through it. Where's the liquidity inside of it? It would be here and here. So that's your internal range liquidity, and you can see the market trades up into it. Once the market takes internal range liquidity, we now have external range liquidity, which is liquidity that exists outside the dealing range. So the market trades higher, seeks the internal, and then trades lower into the external range liquidity, which is the liquidity that exists outside the dealing range. So you can see here, this is an obviously defined range. It trades up into a premium market and then attacks the external range liquidity that exists outside of the range. So price moves between internal and external range liquidity and vice versa. So it'll go from internal to external and external to internal. And what you're going to see is that price does not move randomly. It's delivered very systematically. And this is how you're going to see that price delivery becomes predictable. So external liquidity is going to be an expansion outside of the range. And internal liquidity is going to be a retracement back into the range. So you're going to see the sequence repeated in all markets on all time frames. So first, external liquidity will be targeted. It's going to reach for some liquidity outside the range. In doing so, price is going to expand, right? Because it has to expand to reach that liquidity. Now, once that expansion occurs, we now likely have a range that's been created, right? And then price retraces into this range. So here we have liquidity that exists outside the range. It attacks it. This expansion creates the range, and then it retraces back into the range. When price retraces into the range, the internal liquidity is engaged. So you'll see here, if we go to a 3-minute chart, we have a high inside this range. It seeks the internal range liquidity back to the external. So you're going to see this is a very common delivery sequence. The markets do the same things every day. Now, it might not look exactly the same, but you're going to see the market follows the same frameworks. So these frameworks are going to help you frame price runs, anticipate continuation, and also anticipate retracements. So you're not chasing price and you let the market come to you. So price moves by expanding to the external range liquidity, retracing to the internal range liquidity, and repeating this process. So external to internal, internal to external, rinse and repeat. So now that you understand how price moves between internal and external range liquidity, the next step is determining whether institutional order flow is bullish or bearish, so that you can trust the price swing you're watching and expecting to unfold. Remember, the process always starts by identifying the drawn liquidity. Once you know what the market is drawing towards, the way you gain confidence that price will continue delivering to that liquidity is by studying institutional order flow and how it's unfolding. And that's exactly what we'll break down next. So now we're going to get into a very important one here. Institutional order flow tells you whether a move is likely to continue or likely to fail. So at this point, you already understand what the market draws to and why it draws to specific levels. Institutional order flow is what's going to help you trust whether that move is likely to continue or whether it's not likely to continue, which is information you want to have when it's presented to you. So when the order flow is clear to you, entries are easier, right? One of the first things I'm asked is, Dylan, show me how to take an entry. Like, where do I get in? And what you'll understand is that once you learn how to read price action, right? You know what you're doing, you know how to read order flow. Entries are so easy because that's the easiest part of this whole equation. The big thing is knowing where's it going to go and when's it going to go there. Once you understand that, entries are the easiest part. And once you understand institutional order flow, you're going to see it is very simple to get into these moves. But first, you have to understand where it's going and why it's going to go there. And stop loss placement becomes obvious. So, Dylan, how do I place the stop loss? How do I know, okay, I can see how I can enter here on these gaps or on liquidity, but now where does the stop loss go? Once you learn how to read institutional order flow, stop loss placement will be obvious for you. And trade management becomes simple. Because now it's not, okay, well, how do I trail the stop? How do I know where to take profit? How do I know if the move is still good or not? All of that is simply answered by understanding institutional order flow, and trade management becomes simple. So all the things that you're concerned with now, how do I manage trades? How do I take entries? Where do I place my stop loss? All those things are simply understood once you understand how to read price action. So reading price is your number one pursuit. Once you can do that, all these other things easily work themselves out. And again, that's why when I'm working with traders, our biggest focus is learning how to read price, because executions are just a byproduct of learning how to read price action. So let's get into how we read order flow. We determine order flow by observing highs and lows, imbalances, and up close and down close candles. So at a basic level, institutional order flow is determined by how the market reacts to highs and lows, imbalances, up close and down close candles. Let's get into some examples. Bearish order flow is when highs are rejected and lows are displaced through. So let's look at this example here. We see we have a high here. So we see the market trades up into the high, and then we trade down to the low, but we displace through it. So you see the high is being rejected and the low is being displaced through. Here we have two highs here. The market trades above it and rejects it. So highs are being rejected. This low here is being displaced through. This low here is being displaced through. This low here is being displaced through. And this low here is being displaced through. Whenever you see that, that is the surest sign you're in bearish institutional order flow. Vice versa, bullish institutional order flow will have lows rejected and highs displaced through. So we see here, low rejected, high displaced through, low trades down below it, rejects, high displaced through, low here, rejected, another little low here, hits it, rejects, high displaced through. That is bullish institutional order flow. So how the market utilizes imbalances also indicates institutional order flow. So looking at this example here, we have these gaps that are these one-sided imbalances in price. And what you want to study is how the market uses these imbalances. So the market trades up into this imbalance here, can't get above it. That's telling you it's bearish. Another imbalance here trades up into it, telling you it's bearish because it's rejecting away. Another imbalance here trades up into it, acts as real resistance and sends price lower, the surest sign that you're in bearish institutional order flow. Now for bullish institutional order flow, you're going to see gaps that are bullish support price. So we have a gap here, market trades down into it, uses it as support, gap here, support, gap here, lends support, and the market rallies higher. So when you're in bullish institutional order flow, gaps will support price higher. And then lastly, in bullish order flow, down close candles act as support. So looking at this here, we have a down close candle, trades down into it, acts as support, down close candle, hits it here, rallies away, down close candle, trades into it, acts as support, down close candle, trades into it here, acts as support. So when you are bullish, you want to see down close candles supporting price the whole run higher. In bearish institutional order flow, up close candles should act as resistance. So here we have up close candles, trades into it, resistance. Up close candles here, trades into it, resistance. And then we have even these three up close candles here, trades up into it, acts as resistance. So every time we trade into an up close candle and institutional order flow is bearish, you expect it to trade away from it. And that's going to tell you that institutional order flow is still valid. Now, what happens if you start seeing the market trade through up close candles or trade up through imbalances or start displacing through old highs when you thought we were bearish? We're probably not bearish, right? So you have to take that information as you get it. And this is what's going to help you understand if your trade is still valid or if you should leave that trade alone and focus on something else, or if the market is sloppy, right? If it's sloppy and it's not clear what the order flow is, that's also telling you something as well. So order flow comes first, market structure follows. What I mean by that is everything we just talked about here is anticipating market structure. If you're bullish and it trades below a low, it's going to trade down, hit that low and quickly reject. That's an intermediate term low, which you'll learn what that means later on. Same thing if we trade into a gap and we hit that gap, we expect it to do what? Use it as support and rally. So you're predicting that a low is going to form there and it's going to make a higher low. So order flow predicts market structure, right? Same thing with down close candle. If you're bullish and it trades down into a down close candle, that is going to act as support, right? So looking at the example we've been working with here today, we see the market trades higher on this price run here and trades into the up close candles here and into this gap here. So what would you want to see it do? Repel away. 3 up close candles here, market rallies, trades up into it here, and then quickly repels away. Exactly what you want to see in bearish institutional order flow. And then we see here that the lows are being displaced through, telling you the market is weak. And then what you'll see here is there's a gap here and up close candle when we're bearish. So we expect that this is going to be a key high here. So we talked about market structure early on, how there's a high, lower high, lower high. And what you're going to see is market structure actually lets you anticipate that. So order flow is much more superior than market structure because order flow is actually going to tell you where the swing points in market structure are going to form before they do. So order flow tells you whether to stay in a trade, right? If you are in a trade, you want to see everything we talked about hold true. And it's going to tell you whether to exit, right? Because now if you start seeing warning signs, indications that, hey, look, this thing isn't bullish, it's not bearish, you can know to exit your trade. And also it's going to tell you whether to stop looking for entries. Because now if the order flow is sloppy, if you can't read it, if you can't really determine where it's trying to go, then that's the surest indication that you should stop trading, stop looking for entries, and wait for it to become clear and obvious. So if order flow is unclear, it's telling you that the price action is trash. Stay away from it. And again, that's going to be your cue to stop trading and stay patient. So liquidity is the draw, and order flow tells you whether price will deliver. And you're going to see this is how everything comes together. So now that you understand how institutional order flow confirms or validates a move, The next step is learning the specific, precise locations that institutions use to execute. That's where the PD arrays come in and where we start getting much more precise. So up to this point, a lot of the things that we've been talking about have been foundational. And now we're going to get into the specifics of precision trading and how to know what key levels institutions are going to trade off of and how you're eventually going to start taking entries off these levels. Right, now we're going to get into the ICT PD arrays. ICT PD arrays are specific levels in price that the market consistently utilizes. So now, what are PD arrays? What is an array? If you don't understand or come from a background of computer coding, that's fine. I'm very challenged with coding in that whole world myself. What you have to understand is the markets are rigged and they're scripted. If it's rigged, if it's scripted, it would be very consistent in how it delivers. What we look at in price is we're now taking it one step further and we're looking at PD arrays. What PD arrays are is premium and discount arrays. So there's key premium levels above market price and there's key discount levels below market price. So PD arrays are not indicators. It's simply levels in price action that the algorithm will use or the market will use. And now what learning the PD arrays are going to do is it's going to help you understand institutional order flow at an even more advanced level. So bullish institutional order flow is when PD arrays below market price, which we refer to as discount arrays. Discount arrays are key levels below market price, act as support. So when key levels below market price act as support, that is bullish institutional order flow. Vice versa, bearish institutional order flow is when PD arrays above market price, premium arrays, act as resistance. So PD arrays is premium and discount arrays. Premium arrays are levels above market price. If it's bearish, it should act as resistance. Discount arrays are levels below market price that if it's bullish, should act as support. So highs and lows are the first PD arrays you learn, right? The market trades the highs and lows to engage liquidity. This is the foundation. So an old high and an old low is a PD array in and of itself. So looking at the charts here, we see this high here is a premium array and it trades up into it, right? Same thing here with these equal lows. They're a discount array and the market's going to gravitate to that level. So this is going to be the foundation, right? The first PD array you're going to start with is old highs and old lows. That's going to be the first one because this is going to be the foundation for you. Again, highs and lows are going to be a key level because that's where the liquidity is. The obvious stops are all going to cluster at these highs and lows. So looking at this example here, we see when the market is bearish, it's actively seeking discount arrays. So we see here, we have this low, the market attacks it when it's bearish. We have a low here, market attacks it when it's bearish. This low here, the market attacks it when it's bearish. So when the market is bearish, it's going to seek discount arrays and trade lower. And then what you'll see at the highs when institutional order flow is bearish is it's going to reject those premium arrays. So let's look at this example here. We have a high here, it trades into it, rejects the premium array. We have a high here, trades up into it, rejects the premium array. So when institutional order flow is bearish, you want to see, again, those highs being traded up into and rejected. For bullish PD arrays, right, you want to see highs traded to. So if institutional order flow is bullish, you expect the market to gravitate higher to premium arrays. And in this example, we're looking at highs. So you see the market drives higher to the highs for premium array, drives higher to the highs for the premium array here and here. Now, when the market trades below old discount arrays, we see this low here is an old low. So that's a discount array. Trades into it, hits it, rejects. This low here trades into that discount array, hits it, rejects. This low here trades into that discount array, hits it, and rejects higher. So if you want a simple place to start reading price action, start with the highs and the lows. Turtle soup is a false break of a high or a low. So a bearish turtle soup is when institutional order flow is bearish, price trades above an old high to engage buy-side liquidity, then rejects quickly and delivers lower. So that's the key when you're seeing a bearish turtle soup, which is how the market will use a high. So we see the high here, trades up into it, bearish turtle soup, trades up into it here, hits the high, bearish turtle soup. So a turtle soup is a false breakout. Retail traders see the market trading above this high here, and they're thinking, hey, look, it's bullish, it's breaking out above the high. But that completely depends on context. If the market is bearish, these premium arrays are going to act as resistance. And now for the bullish turtle soup. If institutional order flow is bullish, price trades below an old low to engage sell-side liquidity, then rejects and quickly delivers higher. So look at this example here. The market trades below this low. That's a bullish turtle soup. This low here takes it out. That's a bullish turtle soup. It rejects. Same thing here and here. It trades below the low or trades into that discount array. It should lend support and rally higher. And you see every time we take out lows when it's bullish, it quickly rejects and runs higher. And again, every big price run will set up off some measure of a turtle soup. Now let's get into the next PD array. An order block marks a change in the state of delivery. A bullish order block is the last down close candles or series of down close candles before a strong move higher. So you see here, this down close candle creates a down close, and then we see a quick impulse run away from it. When it comes back down into that last down close candle, that's going to be a bullish order block. A bullish order block is that last down close candle, and you expect it to act as support. Same thing here, down close candle, price runs away from it. When it comes back down into it, uses it as support. Same thing here, down close candle, bullish order block. When it comes back down into it, you want to see it act as support. That's your bullish order block. When institutional order flow is bullish, every bullish order block should support price higher. Vice versa with the bearish order block, it is the last up close candles or series of up close candles before a strong move lower. So here we have these 3 consecutive up close candles. Once price trades back up into it, that's your bearish order block. Price will use that as a premium array, right? So it should act as resistance and send price lower. It does. Here we have an up close candle, trades away from it. This should act as a bearish order block. When it trades up into it, you see it acts as resistance, repels price lower. So when institutional order flow is bearish, bearish order blocks will not allow price to get above it. And this is how you can confirm that the market is weak. It's heavy. So after liquidity is taken, you will get the formation of the order block. Now, for the next one, a fair value gap is an imbalance in price. So we talked about imbalances. Now we're going to get more specific with these imbalances. So a fair value gap is a specific type of imbalance. After the market displaces away from an order block, it often creates a one-sided movement that leaves an imbalance. The market will often trade back into that imbalance to rebalance and deliver fair value. That's why it's called a fair value gap. These imbalances are fair value levels where the market will trade to, and who's it fair value for? For smart money traders to either buy or sell positions depending on what the market context is. So now when you look at price action, you're going to see the market revisit these fair value gaps. Fair value gap here on the big candle lower, trades up into that fair value gap and repels price lower. So it trades up into the premium array, price sells off. We have this imbalance here, fair value gap, market trades up into it, acts as a premium array, real support and resistance, sends price lower, right? If only the support and resistance that we read in our books when we first started, if only it worked this good, right? Looking at an example with bullish fair value gaps. Every bullish fair value gap that you see, the market trades into it, uses it as support. Bullish fair value gap, market trades into it, acts as support. Bullish fair value gap here, market retraces, uses it as support. So what the market is doing here is once it creates these impulse runs higher, smart money is not going to chase price. They're going to wait for it to come back to the fair value gap so that they can accumulate new long positions and anticipate that next price run higher. And now for the last PD array, we're going to talk about the bearish breaker. It's a high to a higher high, and then the lowest down close candle in that swing. So we see here, we have a high, we have a higher high. The lowest down close in the swing, extend that through. That is your bearish breaker. And you see it trades up into it, rejects lower. So you're looking at a high, you wait for that liquidity to get taken, and then you look at that range from the high to the higher high, find the lowest down close, and that becomes your bearish breaker. You see the market uses it, sells off. For a bullish breaker, it's a low to a lower low, the highest up close candle in that swing. So here we see a low, lower low, market gets above it, find the highest up close candle in the swing, that's this one here, extend it through, that is a bullish breaker block. So the market moves between PD arrays to deliver price in a structured way. So when we're looking at the charts here, now it takes on whole new meaning. The market runs higher, takes out this high, rejects, and now we have what? A fair value gap and the order block, the last 3 up close candles. So you see we have a fair value gap, it trades up into it. If it's bearish, it should do what? Sell off. More specifically from this up close candle, last 3 up close candles before the big move lower. That's your bearish order block. Extend it through, hits it, sells off. Now for the breaker, we have a high, higher high, lowest down close inside that, extend these candles through, and that gives you your bearish breaker block in here. And you can see it trades up to the high, trades a little bit outside of it, but that's permissible, respects the breaker, sells off. And then now looking at the bullish example of the PD arrays, we have a low here, lower low, this highest up close candle extended through, that's your breaker. We have a fair value gap. We have these 3 down close candles here, which makes a bullish order block. So when it comes back down into these 3 down close candles before the impulse run higher, this is a bullish order block to send price higher. And then lastly, we have the fair value gap here. Fair value gap hits it, uses as support here, here, and here, and then the market rallies. So here you have examples of the bullish and the bearish PD arrays all in the same example we've been looking at. So one very important thing to keep in mind is you do not need all of them right away. When I first started, I thought I needed all these levels. I needed to master all of them, trade all of them to be profitable. That couldn't be further from the truth. As you get better, you're going to have more components in your analysis. You'll be able to do a whole lot more, see a whole lot more. But early on, all you need to understand is you just need to master one, because one of these is going to be your entry pattern. Once you understand what your entry pattern is, you don't need all of them. Now, to have the ability to read price in a well-rounded way, you want to understand all the PD arrays. And as you study, that's just going to be a natural progression of the work you're putting in. But to start, to get to profitability in the fastest way from point A to point B, it's simply going to be focusing on one of these PD arrays, getting comfortable with it. Because out of all the ones I talked about here, one is going to resonate with you. One is going to jump off the charts and you're going to be able to see it very easily. Whichever one that is for you, bloom where you're planted, get comfortable there. And then over time, you're going to be able to trade more models, more setups, and that's just going to be a derivative of doing the right things like I'm talking about here. So you are not meant to trade every PD array. You will eventually get there, but early on, this is a recipe to add years onto your journey to profitability. You want to start with one and get very comfortable with it. We're going to talk about backtesting and what that means a bit later on in the course. But when you are backtesting, when you're studying, what does that mean? It means when you're looking at the charts each day, the market had a daily candle, hourly, 15, 5, 1 minute, and you're breaking it down, right? You want to look for your PD array within that. And then over time, what's going to happen is you're going to get confidence. You're going to see, okay, it generally uses these levels a specific way. It doesn't work all the time, but it works more than it doesn't. And now you're going to start having confidence behind what you're doing. And you're going to start seeing the statistical edge play out in your favor over time, day after day. And now that's where the confidence comes in. So now when you're ready to risk money and make money, you know exactly what you're doing. So again, over time, you will be able to get good at using all of them, and you will have far more opportunities available to you. But again, keep in mind, this is not the pursuit right now. You first want to learn how to manage a little bit of opportunities, then you'll be able to manage a lot of opportunities when they come. Up to this point, you've learned what the market uses to deliver price, liquidity, inefficiencies, and PD arrays. But knowing where those levels exist isn't enough on its own. The next step is understanding where you are in the bigger picture, so you know which PD arrays actually matter. That's where top-down analysis comes in. It allows you to frame the market from the higher time frame first, then refine that context down to the lower time frames. So you're not reacting blindly to every potential setup you see on the lower time frame. A big problem traders have is they just zoom in right away to the 1 minute, these lower time frames, and those time frames are great, but first you have to understand what the higher time frame is doing. And once you understand what that higher time frame is telling you and what it's trying to do, understanding the lower time frames becomes very easy to do. Alrighty, top-down analysis. Top-down analysis is aligning higher time frames and lower time frames to trade in the same direction as the market's drawn liquidity. So there's going to be a drawn liquidity that you're looking at on each time frame. What you're looking to do is align those time frames. What you're going to learn is the best setups have time frame alignment. And all that means is simply this here, right? We have our 5-minute chart. And the 5-minute chart is bearish, right? Because we have equal lows here. You understand the market likes to draw to those lows. We traded up into a gap here, right? And this gap is repelling price lower. So where's it going to go? It's going to go down to the lows. So if this is a 5-minute chart and I drop down into a 1 minute, what are you going to see? You're going to see the same price action, except you're going to see it with more detail. So now looking at the 1 minute chart, we're looking at this same price swing lower, except now we're looking at it on a 1 minute. What top-down analysis is let's say the 5-minute chart that we were looking at, let's say that's a daily chart. And now that's giving you your daily bias, right? Where the market's likely to draw to. All you're simply doing now, once you understand that the 5-minute chart is bearish, now you just go into your 1 minute or your lower time frame, and then you look to frame your setup within the context of the higher time frame. So if the market's going to draw lower on the 5-minute chart into the levels down here that we talked about, then it goes without being said that the 1 minute chart is going to drop as well. And now you look for your entry models, your pattern, your PD array in the lower time frame, but within the higher time frame context. So the higher time frame is going to define where price is drawing to, because what you have to understand is more capital operates on the higher time frame, right? Banks, institutions, they're trading on monthly, weekly, daily charts. So the order flow, the big inflows that are coming into these markets are happening based off the higher time frame. So what you want to understand is what the higher time frames are doing, because this is going to be your highest probability drawing liquidity. Where's the market drawing to? And you're going to ascertain that information from the higher time frames. So the lower time frame cannot override what you're seeing in the higher time frame. You want them to be in agreement. So time frame alignment means that the higher and the lower time frames are moving in the same direction, right? Like a daily chart, a higher time frame can be bearish, but a 15-minute chart can be bullish within that bearish price run, right? You can still trade counter to the higher time frames, but just understand that the highest probability setups are going to be in alignment with that higher time frame, right? Going back to our example here, if you can see that the 5-minute chart is likely to want to trade lower off this gap here, you don't want to be on a 1-minute chart in here trying to buy this market. because the higher time frame is telling you it's weak. We hit the gap, there's equal lows below. So you're going to look for your lower time frame to align with the higher time frame. That's what time frame alignment means. You don't want to be in here on a lower time frame trying to buy this market, looking for patterns, because it's not going to work, because the higher time frame will dictate the lower time frame. The lower time frames are not noise, they follow the same rule. So I'm also not saying that the lower time frames are not helpful. You're going to see a lot of people out there in the industry tell you the lower time frames are noise, they're not helpful, nobody can make money trading lower time frame charts, and that is absolute garbage. That is not the truth at all. The lower time frames are very precise, but you have to know what you're doing. And that starts with looking at the higher time frame. And this starts to introduce the understanding that price is fractal. So the liquidity, imbalances, PD arrays exist on all time frames. Now what you're trying to understand is the context top down as to what it's trying to do. So now looking at this context here, so even if we go down into a 1 minute chart from the 5 minute, right, we're looking for it within the context of what we're already looking for, which is lower prices. So if the 5 minute, or let's say the 15 minute is bearish, right, on the lower time frame 1 minute chart, you're simply going to look to align that with what you're already looking for. And you can see it's not noise, but you have to understand what the higher time frame is doing, and then the lower time frame will get very precise for you. And you want to understand that price delivers the same way across all time frames because it's the same price, right? So the 1 minute chart is doing the same exact thing that the 5, the 15, the hourly, and the daily is doing. It's just simply showing it to you across more candles. So people that say lower time frames aren't helpful or it's noise, they have no idea what they're talking about because it's the same exact price. It's just simply looking at it across different time intervals. So to recap, the higher time frame defines the drawn liquidity. So before you ever look for an entry or how to get into a market, the first thing you have to know is where's the higher time frame drawn liquidity? Where's it likely to draw to? So if the higher time frame is drawing lower, you're going to use the lower time frame to get into moves as the market's moving higher. And if the higher time frame is drawing higher, you're going to use the lower time frame to get into moves as the market is dropping. We want to try to buy when markets are dropping, and we want to try to sell when markets are going up. That's part of that market efficiency paradigm, right? So if the market's bullish, right, and it drops down into these 3 down closed candles or a bullish order block, that creates a buying opportunity. So you want to buy when the market's dropping. Or if you're going to buy this gap here, you're buying as it's dropping into that gap, right? And same thing with the breaker. Low, lower, low, highest up close. You're buying when it's dropping into that level. Same thing when you're selling. You want to sell when the market's going higher. So you can sell into this high here, or you can sell into this gap, or we have 2 up close candles here, so you can sell into that bearish order block. But you want to try to sell when the market's going up into a premium array, and you want to buy when the market's going down into a discount array. And then the lower time frame is the executable time frame. So once you understand where the higher time frame is likely reaching for, in this example we're using the 5 minute chart, it's bearish to reach into these lows here, then you can go into a lower time frame, lower than this one, and look for your entry pattern. But your entry pattern has to be aligned again with that drawn liquidity. And do not trade against the higher time frame draw, right? There are times when the higher time frame can be bullish and the lower time frame can be bearish. However, you have to really know what you're doing to trade against that higher time frame. So my recommendation is if your higher time frame, let's say weekly, daily, and hourly chart is pointing bullish, you want to be very careful trying to go short because the market will smoke you trading against that higher time frame. Over time, you will get more experienced. You will be able to do a whole lot more with the market. So you can sell in bullish markets and you can even buy in bearish markets, but you just have to really know what you're doing. And early on, you want the highest probability trades. And the highest probability trades are going to be in agreement with top-down analysis or what the higher time frame is telling you. So when you're doing analysis, when you sit down at your charts and you're practicing, you're doing your technical analysis, you always want to start on the higher time frames. So you start from the higher time frames and work your way down. That's what top-down analysis means. And this is the most precise way of trading because now you're blending what the higher time frame is telling you with the lower time frame. And this is where you're going to get your precision elements because now you know what the higher time frame is doing, and then you can really refine it into the lower time frame for precision trading. And what many traders have issues with is they just start on the lower time frame. So they have no context for what the higher time frame is telling them, and they're just getting smoked trading lower time frame patterns without the higher time frame context. And you're going to see that top-down analysis removes that randomness and gives you structure in your decision making. Then once you start on the higher time frames, you then work your way down into the lower time frames. Don't make the mistake of starting in the lower time frames, looking for an entry, being in a hurry to get into a move, because you're going to find out that you're going to be in a hurry to get into a losing trade. And you want to focus on the higher time frames, then work your way down from that. So we'll look at an example in practice. So in top-down analysis, we're going to look at the 15, the 5, and the 1 minute, working our way down. So let's look at the example we've been working with here for today. So looking at the 15-minute chart here, we see the market rallied higher, and now they left this low here and this low here, which is relatively equal, and this low here. So now the market trades lower, and now we have this low here that's relatively equal to this one, and then it trades higher. What does it trade higher back up into? Well, we see this run here is a big impulse move down. So the last up close candle before this drop is a bearish order block. So you can see here the market trades higher, hits the last up close candle, bearish order block, and then rolls over because of the draw on liquidity. The market's drawing into these relative equal lows, this low here, and then as far down as this gap here. So this is the only other type of gap you'll see. We talked about fair value gaps, but this is not a fair value gap. This is a liquidity void. The reason it's a liquidity void is because no trading occurred inside this range. The market closed here on this day and opened here on this day. So this range is a liquidity void. It's not a fair value gap because no trading occurred inside this range. And you can see this is a strong draw for the market to want to trade down into. Again, there's only two reasons the market moves: liquidity or inefficiency. So now we see the 15-minute chart trade higher into the 15-minute bearish order block, and we have all these levels down here that are going to act as a magnet on price action. So this is how you want to see price, right? The magnet, which is these lows here and here, and this gap is going to pull price down into it. So we're starting with the 15-minute chart. You can see why we're bearish, and now we're going to refine it down to the 5-minute. So on the 5-minute, we can see it's the same price. It's just more details. Market rallies higher at 9:30, breaks down, retraces higher into the last three up close candles, which is a bearish order block on the 15-minute time frame. And also, we trade into this fair value gap here. So now, if it's bearish, if it's going to draw lower, and we're trading inside of a fair value gap, it should do what? Repel price lower. So now we have the fair value gap that we expect price to repel away from and draw down into these levels here. So now we can drop down into our 1-minute chart. And now we can have confidence that the move is starting here and it's likely to deliver down here. So now we use the tools that we've learned in price action. We have a range high, we have a range low, which gives us a dealing range. So now we want to measure that range here. And we can see the market trades higher into equilibrium and above it, which is a premium market. More specifically, trading into an optimal trade entry here. And also, you can see a big 1-minute fair value gap here. So that 5-minute gap that we had, we can now refine that down to the 1-minute. And now this is where you would look to take your entry. So you can take an entry inside this gap here, or when the market breaks down here, there's another order block here. So when the market drops here, there's a breaker here because you can see we have a high, higher high, lowest down close, extend that through. That's your bearish breaker. We have an up close candle here. You can sell into that as a bearish order block. And then you can see here we have a fair value gap here. So it trades up into the gap and up close candle. All of these are tradable opportunities down into this low here. So now you just saw an example of top-down analysis. We framed where the 15-minute chart was going, lower. We refined it down to the 5-minute, which gave us even more precision. And then we ultimately refined it down to the lowest time frame, which in this example is a 1-minute chart, where now you understand where the price run is likely to start, where it's likely to go, and then you can see all the tradable opportunities that form with what we've taught inside this price run here. And this is an example of top-down analysis. You start on the higher time frame and work your way down for precision elements. So in summary, nothing is changing across the time frames. You're simply refining. So what happens to many traders is they get lost, right? They'll start on an hourly chart or daily chart, and then by the time they get down to the 1-minute chart, it's like, what the hell am I even looking at, right? This is why you want to go through this process. And it's not something you're going to get on your first day. That's fine. It took me a long time to get really, really good at this. But the way you do it is backtesting, putting in the work, and spending time on your charts. So now you understand why the markets move, where price is drawn to, right? Where does the market like to go? And when price is most likely to move, right? The when component, very, very important. It's not enough to just know where markets are likely to go. It's very important to understand when they're likely to get there. How to read institutional order flow. So you understand institutional order flow and you understand advanced institutional order flow using the PD arrays. You understand how price uses these PD arrays and now how you can also use them for entries. Because if you're bearish, PD arrays should not allow price to get above it. So that's where your entry would go and your stop placement would go above that, right? So you see how reading price action and knowing how to do so eliminates all the questions you have about, well, how do I get in? How do I place a stop loss? How do I know where to take profit? All these things are easily answered once you have a well-rounded understanding of price action. And then lastly, you learn how to align your time frames for high probability execution. What I want you to take away is that nothing you learned in section 2 is a standalone. What you're going to see is how all these factors come together. If you're new, your head may be spinning right now with all these different things. That's completely fine, right? This is very technical. This is very refined. And you're going to see that it's really not that complicated once you spend time with it. At the end of the day, all you're doing is determining where's the draw on liquidity? Is it the right time of day for the market to move? And does it give me an imbalance in the direction that I'm looking for? And once you have that, you can see that this will become very, very simple, but you have to go through all the foundational things for you to get to that point. So from here, the focus shifts to execution. That means risk management, defining a trading model, building a plan, journaling, and creating consistency. That's what we'll cover in section 3. See you there. Welcome to section 3. So at this point, you understand how price is delivered, and that's only half the equation. Most traders fail at execution and not analysis. This section is about protecting capital, building structure, and thinking like a professional. And this section is about showing you how to execute properly without blowing up. Anybody that's a profitable trader will tell you they had to go through periods of blowing accounts, losing money before they got into success. Now, once you get successful, everything you had to go through to get there becomes worth it, but you don't want to make the learning process miserable. You don't have to lose your ass. You don't have to lose a shitload of money trying to learn this if you do the right things. And it's my goal with this to save you that pain, because this doesn't need to be a painful process to learn, but only if you approach this the right way. So risk management is the most important skill you will ever learn in trading. You must first learn how to protect your money before you can ever grow it. And trading without risk management is simply gambling. And if you come into the market without risk management, without money management, the markets will absolutely end you because they are extremely unforgiving. And if you come and you offer your neck to the market, it will absolutely take it. So you should know exactly what you are risking before you ever enter a trade. So before you even get into that trade, you should already know what you're risking and what you're willing to lose on that transaction, whether it's demo or whether it's real funds. So a stop loss is not optional. You first define the risk before you ever even concern yourself with the profit. Most traders have it asked backwards, right? They're just focused on what they can make, the profit. They don't even think about the risk. They just impulsively jump into positions and they wonder why they're blowing accounts every month. This is easily fixable, but you have to be risk oriented. Focus on the risk before the profit, because the profiting is easy. The risk management is the key. And what you have to understand is that losses are a part of the business. And as long as you manage your risk, losses are no big deal. But if you don't have risk management, the markets will expediently kick you out the door. And poor risk management is what destroys accounts. So the very thing you may be fearful or concerned of is, well, I don't want to lose my funded account, or I don't want to blow my live account. This is easily fixed by having self-control and following a plan with good risk management. So your risk, your stop loss, and your take profit should all be defined before you even get into a trade. So now I'm about to show you a market replay example of what executing is going to look like, what it looks like to have your risk defined, your take profit defined before you even get into the trade. So looking at price action here, 930 opened, big displacement lower, and we have the indication that the market is likely going to trade down to this low here and is potentially as far down as this gap high here. So now we want to start looking for a short position. Remember what we learned this far, though. We don't chase price. So you don't want to be like Retail Rick, who's going to be selling down here, chasing, thinking he's going to miss the move. You have to be patient. You have to let the market come to you. Now, what that looks like is once you get this candle here, we now have this gap here. So this is a premium array in the form of a fair value gap. So you expect it to prevent price from going above it. So what you can do is you can sell inside that level. So you can double click, put a sell limit here. And now before the market even trades up into that level to activate your order and get you into the market at this specific price, you already know where the stop loss is going to be, which is going to be above this high here. So we'll play price forward. This has now activated your order. It's traded into this gap here. And again, we're referencing this fair value gap here that's created on this imbalance because we expect price to stay below it if it's going to attack these lows here. As soon as you take your entry, you know where the stop loss is going immediately. It's going above the high. Now, eventually, you'll be able to get better and realize that the stop can go here. But just to keep it simple, we'll put it above the high here. And you already know where your take profit is. You're going to be aiming for the lows here. Right? We'll just say, for this example, you knew the market was likely going to trade into this gap here. So we'll use this here. So the market trades higher, hits the fair value gap. You know where the stop is, and you know where the take profit is before you even get into the trade. So the risk is defined. Playing this forward, see the market trades higher into this gap here. Now you want to see it repel away. You don't want to see it overtake that gap, because if it does, now that's telling you either the market's bullish or it's sloppy. And then we'll play this forward. And then we see the market runs away from the fair value gap, up close candle, and trades down into the limit order here. So now looking at the executions, you can see that we sold here inside the gap, and then we covered here. So you can see before you ever get into a trade, you already know where the stop loss is and you already know where the take profit is. So the risk is defined. This is what separates what we're doing from casino time gambling. We know how much we're risking. We have a statistical edge. We know when to stop, and we know how to manage our trades. Right? And that's what separates gambling from trading. Even great price action traders fail without proper risk management. So I don't care how good you get at reading the charts, no matter how much you study, how good you get at seeing setup, seeing where the market's going, even the best traders will fail without good risk management. So think of risk management like your safety net. You don't have to be perfect. You can have losing trades, you can have difficult days, but it doesn't need to cause you to blow up, lose your account, have significant financial harm done to you. That doesn't need to be the case, right? Once you have risk management, everything will become a lot more simple because now you're not stressed out about the next transactions or the next series of transactions because your risk management is going to catch you. So you're not going to blow your whole entire account or lose all your money on a few trades because you have risk management and you have a system that you're following. That's what separates gamblers from traders. So losses also don't necessarily mean you're doing something wrong. It's completely part of the business and it's the cost of doing business. For you to be in the markets, for you to trade, for you to make profits, you have to be willing to lose some trades. And that is simply the cost of doing business. And that's why you have to have risk management. No matter how good you get at reading price action, you hear the things we talk about here. There's a lot of confidence in what we do, but that does not mean it's a guarantee on every transaction. Now, there's a lot of probability behind what we're doing, but there are no guarantees. So you always have to have risk management. And this is going to help you make sure that your losses are controlled. Consistency comes from repeatability. So what this means is what you're probably doing now isn't repeatable, right? You're trying a new strategy this week. You're trying another one this week. You're having emotional problems the week after that. And then the next week, you're just frustrated and you're on tilt the whole week trading. You cannot have profitability that comes from that because there's no repeatability. You're not doing the same thing week after week. So if you're not bringing consistency to the market's not going to reflect consistency back to you in the form of profits. So if you're constantly watching a YouTube video, trading this strategy the next day, you lose, look for a new strategy, look for a new Discord, look for a new mentor to coach you. That's just going to delay your arrival to profitability because you're not doing anything consistent. So you're never going to find consistency until you become consistent yourself. And one of the ways that you get to consistency is you need to have rules. You need to have rules that give you structure for what you're doing. So you'll have a trading plan next to you that tell you the rules. When this happens, you do this. If this happens, you do this. And there's nothing up for interpretation. You follow your rules and that's it. It's done. And lastly, you don't need more strategies. You just need one model that you execute consistently. I've been there myself, and I know many of you guys are there. You think profitability is on the other side of this next strategy or this next YouTube video or the next thing you're going to see, but that's not the case. Profitability is going to come from you being consistent and executing consistently. And that comes from what we talk about here. Get consistent with one model. What we do repeats, and over time of practicing with that, you will get consistent. And then eventually that consistency grows into big money. But there's a lot of stages that you're going to have to go through first before you get into the big bucks. And repeatability comes from having a defined trading model. You have to have your model defined. And what is a model? A model is what gets you into a trade, right? What things need to happen for me to take a trade? You want your model to be very simple. If you don't have a simple model, if you can't articulate and express your model in under 30 seconds, you don't have a model. The model I use every single day, I'm looking at 9:30. I'm looking at the liquidity we have to the left. I'm seeing what liquidity they run to first at 9:30. Once I see what liquidity they run to first, I'm then going to expect opposing liquidity to be delivered. I'm going to wait for a displacement that creates a fair value gap. I'm going to enter on that gap and I'm going to target the opposing liquidity. That's it. That's a full complete model. If you want to know more about that model, you can check out the One Setup for Life series, which you can see on our YouTube, where I break down the trading model that I'm using every single day. Because what you want to get away from is what most traders are doing. Random executions at all different times of the day, all different types of models, no consistency whatsoever. And the traders are wondering why they're not getting any results. But it's very simple. You're not doing anything consistently. And that's going to start from having rules, having a model, and sticking to it in a disciplined way. To get meaningful data, you must execute the same strategy consistently, right? So for you to journal, for you to collect data, which I'll cover how to do that later on, you must execute the same strategy consistently. Because if you're not executing your strategy consistently, you're not going to have any meaningful data, right? Your data is going to be not helpful because you're just doing random things all the time. And all it's going to show you is that you're not getting the result because you're not doing the right things, which you already know that anyway. So to start collecting meaningful data so that when you're journaling, when you're back testing, when you are collecting data on the setups you're taking, you can actually have meaningful data only if you execute the same strategy consistently. Not 5 strategies, not 4, not 3, 1, and getting consistent with it. Then once you do that, then you can grow into having a lot of strategies, a lot of models, and more opportunities. But that, again, comes from experience. It comes from time. If every trade is different, right, you can't measure the outcome. So what you want is for all your trades to look the same. Your trades should all look similar because there's similar characteristics that's getting you into those trades. And that's a sign that you're heading in the right direction to become a profitable trader. So the consistent behavior is going to produce the consistent results that you want. So now let's get into trading plans. A trading plan tells you what you trade, meaning what market, right? Are you trading S&P, NASDAQ, crude oil, gold, Forex, stocks, options? What are you trading, right? You have to have that defined because if you're trading Forex one day, futures the next day, commodities here, oh, look, it looks like crypto is going to do something. Let me go trade crypto. You're not going to be profitable either. So you have to define what you're going to trade. After that, you have to define when you're going to trade. Another problem traders have is, like you see, the market's open 23 hours. So what stops you from trading Asia, London, pre-market, the AM session, the PM session? There's all these sessions that you can trade, but you have to define when you're going to trade. Because if your trading plan does not have this defined, you're going to gamble on all different markets. You're going to gamble at all different times of the day, and you're going to have no self-restraint, no self-control, and your results are going to stay the same. Professionals are not improvising every day, right? They have a plan, and they're simply executing that plan. And when you do nothing, right? So your trading plan also has to tell you what days are you trading and what days are you not trading, right? That has to be very clearly defined. Because what you're going to see over time is not every day delivers the same. Some days are sloppy, some days are good, and you're going to determine over time which are the days you want to be trading, and this all has to be in your trading plan. If you do not have a trading plan, you will not make consistent money. You might have flash in the pan victory, you might make some here, make a little bit there, but until you have a real trading plan, you will stay unprofitable. And it's my goal to help you guys cross that threshold into profitability, but you have to do these things. You have to go the extra step. You have to do what the losing traders that are in a hurry, that are in a rush, they're not focused, they're not patient, they're not doing the right things. You have to do what they're not willing to do, right? If you want to make it to the few percent, you have to be willing to do what the herd is not doing. And that's going these extra steps to have discipline and have professionalism to what you're doing. Your trading plan must also define clear weekly, monthly, and daily goals, right? Because if you're not aiming for anything, you're not going to hit anything. So you have to have a monthly goal, a weekly goal, and then a daily goal. Once these things are defined, you can now have goals, reach them, and stop. And if you don't reach them, you now have a baseline that you can measure and see what you can improve. But if you don't have goals and you're just swinging for the fences every time you sit down and trade, that's probably why you're getting the results that you're getting. Because you don't have a plan, you don't know how you're going to get there, and that shows up in your results. The way you cross that threshold into profitability is you have to know what you're doing. You have to know why you're doing it. What are you going to look for? What causes you to stop? Because then you're going to run into a lot of problems as a trader, right? You're going to make $1,000. You're going to make it super fast on Monday. And then you're going to want to do what? Wow, I want to do that again. That felt really good. I want to trade more. And you're going to what? Go back in on that Monday, and then you're going to lose more than what you made. And now you're going to be down, right? And that all could have been fixed by simply having a plan, knowing what you're aiming for. When you get it, you stop. This is how you get profitable. So this is going to be a non-negotiable, and it's all part of the trading plan. A trading plan should only be one page. It's very simple, and it just has 3 sections, much of which I've covered here. For journaling, now at the end of every session, you have to journal. So after you're done trading, this is what I do. As soon as I'm done trading, I sit down, I look at the trades, and I journal. What do I journal? The first thing I look at is what I did well, right? Because you have to have your journaling be positive. Trading is going to be hard enough. And what you're doing is you're building that inner trader within you, who initially, right, is like a kid, right? When a kid brings you a drawing, you're not going to throw it in the trash and say it's the worst thing I've ever seen. You're going to hang it up on your fridge. You're going to say, hey, look, man, this is really good. You're going to motivate them, right? You want to do that to the inner trader within you because this is going to be hard. You're going to have setbacks. And if you just constantly beat yourself up, you're negative, you talk bad about yourself, I'm such a dumbass. Why am I not making money yet? I shouldn't be profitable. Those are all mistakes because now you're just feeding your subconscious mind negativity. And that's what you're going to be thinking about when you're trading. Dumb shit instead of what you should be focused on. So you want to journal. What did you do well, right? What did you do well that you recognize that you can keep doing going forward? Next is what can I improve? Again, not I'm such a dumbass. I hate myself. I always pick the wrong fair value gaps. This shit never works. That's not what you want to journal, right? What can I improve? Right? So like, what did you do well and what can you do better, right? Maybe I didn't look at this time frame and I could have added this, or wow, I didn't even consider this. So this was a great learning opportunity for me to be able to determine how to use the higher time frame because I forgot to use it today, right? That's how you want to frame it. You want to frame everything positive, not negative. And would I take this trade again? So when you're looking at your trades, you're looking at your decisions, the first thing you want to look at is, would I take this setup again? Because if the answer is yes, that means you followed your model, you did the right things, and your trades all look the same. If the answer is no, and you wouldn't take the same trade again, what are you doing? Right? You're trading things outside your model, and that's probably why you wouldn't take the trade again. So this is something you really want to focus on because this is how you take quality trades. That doesn't mean every trade is going to be a winner, But this is how you take good setups that are in alignment with your model and it's consistent. And that's determined by would you take this trade again? And your goal is to have every trade you take be a yes. Yes, I would take this trade again, even if it's a loser, right? Because again, you're going to have losing trades, but it's just all on how you manage it. What did I observe and what did I learn today? Right? So maybe you're going to learn something. Maybe, man, I forgot to look at that daily chart and man, that would have given me so much clarity, right? Put that in there, learn it, observe it, because now what's going to happen from you doing that is the next time you're going to have that in your subconscious mind. Oh, I forgot to look at the daily chart that day. Let me look at it today, right? And then that's how you're going to improve as a trader and start self-correcting. This keeps journaling simple and sustainable, right? There's either two traders that come to me in book calls. Either they don't journal at all because they have no idea what they're doing, or they do journal, but they journal for 4 hours once every month. Neither of those work. You have to be able to journal consistently every single day, but it also shouldn't take you 15 hours. I work with a lot of professionals, business owners, people that are full-time employees, university students, fund managers, all the above. So what I have to be able to give them is a simple, streamlined way to do the right things every day. You can be profitable with simply 2 to 3 hours a day of focus. And that is even an hour to hour and a half watching the market, 20 to 30 minutes journaling, and 45 minutes of backtesting. If you can dedicate 2.5 hours to this a day and focus on the right things, you can become financially free. You can write your own paychecks and you can eat by your own hands. So for journaling, you don't need consistency. You simply just need discipline and consistency of doing it over and over again. So what I use for journaling is Notion. If you want to see the full Notion tutorial on how I use Notion for my journaling, click the video on the link above and you'll be able to see a full breakdown on how I use Notion. But this is what I'm doing in my Notion. In the previous slide, this is what's going inside of it. And I'm simply filling these things out in a Notion page. Now, what I use for performance data is TradeZella. So I use Notion for journaling and I use TradeZella for analyzing my data. So I import my trades, or actually it happens automatically through TradeStation. The broker is connected to TradeZella, so my trades automatically import into TradeZella. So I personally use Notion for journaling and backtesting. So every day, which you'll see in the video, I take screenshots of each time frame and then I put it in my Notion journal. And I have it set up by year, month, week, and day. TradeZella I simply use for data. So I'm not looking at TradeZella every day. I just usually look at it end of week once I'm calculating, okay, this is what I did this week. This is what I can improve. This is what I could do better. I could have managed my risk better here, or I could have made an improvement by sizing down here, whatever the case may be. This is when I look at that and I do it on the weekend because throughout the week, I'm not worried about the money. I'm focused on executing to the best of my ability, trusting that the money takes care of itself. So for TradeZella, I use that for data collection and I use Notion for journaling. You don't need TradeZella right away. So I'm not telling you that you need it right now. When you start collecting data and you want to start having feedback on your trading and you want to be able to look at more detailed analytics, TradeZella is great. But right now, all you need is Notion, and you can even access it for free. You don't need Notion. The most important thing is that you journal. I have old school guys that work with me, and they journal on pen and paper. That's fine. That works. The biggest thing is that you're reflecting. So if you already have a system for doing it, you don't need Notion. But for me, it's very easy. It's organized, and I can look back years at all my reviews, my journal logs, and my backtesting. So it makes it really easy for me to go back to. Makes it streamlined for me. As a full-time day trader, I'm very busy, so I need a very simple, streamlined way to go in and journal every single day. And backtesting is still something that I'm doing daily in my journaling because it keeps me close to price and it makes sure that I'm dialed in. So I'm dialed into the markets, I'm looking at what it did that day, and that sets me up for the next day. At first, though, you're mainly going to be backtesting just so you can know what you're doing, because at first you're going to have no idea. But as you backtest and you put real effort into this, over time, you're going to get better. You're going to get better at seeing price. You're going to get better at being able to predict price runs, have confidence in your entries, and that all starts with backtesting. So if you're not journaling and you're not backtesting consistently, you're not even giving yourself a shot. Nobody that makes serious money with these concepts skipped backtesting and journaling. So now let's get into how you would get started, right? You don't need large capital to start trading. Most people think, I need $50,000 to put into an account to make any serious money. That's not the case anymore. When I first started, it was more like that, right? You needed your own live funds. But now it's never been easier to be a trader. All you need is the right skills and you can get access to as much money as you want. So you don't need large capital to start trading. You need to build the skill first, right? Once you have the skill, the money is going to come to you. People will literally give you money to manage for them if you know what you're doing. So first, build the skill and then you can get into the capital. So once you build the skill, what are some things you can get into to access capital? My recommendation for a newer trader, if I had this, I would have loved to started with this. I started trading with live funds, like real money. So every trade was money in and out of my account. And I lost fortunes trying to do that. my recommendation would be start trading with a prop firm. So one of the options is going to be Tradeify. They're one of the most popular prop firm companies. And looking at the different account types they have here, a 50K account, you can start trading for less than $97 a month. So for less than $97, you can start trading capital. So you don't need $5,000, $10,000, you don't even need $1,000. For less than $100 per month, you can access the futures market and start getting payouts. So again, don't worry about the money. Even someone who may not be in a first world country, you can still scrape together $100 and still access the markets. So don't think, oh, this isn't for me. I don't have big money and I can't, I don't have any investors to, trade their money. You don't need that. All you need is the prop firms. And you can see they have different account types, select, lightning funding. This personally, what I do, it's instant funded because I don't personally want to do evaluations at this stage where I'm at in my journey. The way the funded accounts work, if you're not doing instant funding, meaning you're doing either the growth or the select option, you have to pass an evaluation first. There's an evaluation you have to pass. If you can prove your skill, you can then get access to the capital and then you can work towards a payout. Lightning funded allows you to go directly through the evaluation phase and you start from the funded phase right away. And this is personally what I prefer to do because I'm already at a stage where I don't want to waste time trading evaluations and I just want to trade these direct funded accounts because I'm mainly trading live funds anyway. So for me, just trading the instant funding works for me. But maybe you don't have $350 per account. That's fine. Then you can just look at these other options here that are a lot more affordable and a really good place to start. So for less than $100, you can access the futures market. So now you see the problem isn't money. The problem is skill. And once you fix the skill issue, the money is easily attainable. And then for a live brokerage, there's several CFTC regulated ones out there, AMP, TradeStation, Ninja Trader, and you have Thinkorswim, or Schwab, I think they're called now. Now, I'm not recommending any of these brokers. I'm just saying go into one that's regulated because you'll be able to get your money out. They're solid. I'm not going to recommend any one. Do your own research. And if you want to go through the route of funding your own account, then you can just go into any one of these brokers, deposit an account, and get to work. And I think the minimum margin would just be like a couple $1,000s to get started if you wanted the minimum amount. So that's how you can access the market, either through a prop firm or through a regulated brokerage. Your results will not be long-term without structure and routine, right? So I want you guys want to have long-term consistent results. You don't have hit and miss. You don't have lottery wins, huge losses. And that comes from structure and routine. Once you have a structure, you have a routine that you're following consistently, this becomes very easy. And what do I mean by routine? Well, as a trader, me personally, I have a routine that I do every week, right? Sunday, I'm doing my pre-market analysis for the week. I'm getting prepared. Monday, come morning, I'm already prepared because I'm prepared on Sunday. And then once I get to my charts about 20, 30 minutes before the session at 9:30, I'm preparing them. And then in the evening, right, once I'm reviewing my trades, I'm reviewing the day and how it traded, I'm preparing for the next day. So now when I get to my chart on Tuesday morning, I've already prepared Monday night. And I'm doing that throughout the entire week. And then when I get to Saturday is when I review the previous week. How were my trades? What can I improve? What did I do well? And I'm assessing how I traded that last week, right? So that's the structure. That's my routine that I follow every single week. And you want to start adding routine to what you're doing. You want to start being consistent and you want to start building good habits that are going to lead to becoming the trader that you want. Most people think that they're going to make money first, then they're going to become a professional, right? So, well, let me just get some payouts. Let me just make some money. Then I'll get the right education. Then I'll worry about routines. Then I will build a trading plan. Then I'll become disciplined after I take payouts. That's not how it works, right? You get the skill first. You do the right things first. You get the help. You get the education that you need first. Then you grow into profitability, right? It doesn't come profitability first. Then you just magically become a professional. You have to get the skills first. Then you'll get the money. You can't have a backwards mindset because if now you're just pushing for the money and you don't have the skills, then you're going to keep living with the same results you've been getting, which you probably don't want. So with everything we've covered here, most traders lack accountability, right? They don't have anybody or themselves telling them what they need to do, what they need to improve, and telling them, hey, look, man, stop focusing on the bullshit and focus on the right things that are going to make you profitable and hold you accountable to doing the right things. And this is where most people plateau because they try to do everything alone. They make mistakes. And this is why you hear these horror stories of it taking 5, 10, 15, 20 plus years to get profitable. Lastly, is structure, right? You see what we've talked about up to this point. Without the structure we've talked about here, you're not even giving yourself a chance. Like you're not even giving the slightest opportunity for there to be any profitability because there's no structure. You don't have a routine. You don't have a trading plan. You're not journaling consistently. You're not consistently backtesting the market. So there's no structure to what you're doing. So why are you surprised at the results that you're getting, right? But once you add the structure, everything will change for you. And that's my goal. And then lastly, feedback. You want to know that what you're doing is the right things. And you also want to be corrected if you're doing the wrong thing so that you don't waste time, months, and years of your precious time given towards things that are not going to drive results for you. And having that feedback helps you cut that learning curve so that you know exactly what you should do, what you shouldn't do. And hopefully this course has given you that. Let me show you what's possible when you work with somebody who gives you feedback, structure, and accountability. This is Tyler. When he started, he understood what to look for on the chart. And like most traders, that wasn't the issue. The issue was execution. Some days were good, some days he hesitated, second guessed, and broke his rules. That's completely normal, and that's where most traders get stuck. Fast forward to now, Tyler's producing consistent $15,000 months and days like this. Not from a secret setup or from luck, but because he's operating inside a structured process where execution is repeatable and disciplined. Now, let me tell you about Tommy. Tommy started in a small village in Africa, working his way through college part-time in a grocery store, making about $70 a month. He wanted a different life, so he did what most people weren't willing to do. He studied for years, he backtested, he got frustrated, he lost money, and there were long periods where it felt like it wasn't going to work. But instead of relying on motivation, he prioritized discipline, he leaned on coaching, and he consistently put in the right inputs. Fast forward to today, Tommy's a profitable trader, has taken multiple payouts, and now works at a top-tier firm as one of their youngest analysts, advising and managing institutional capital for high net worth clients. That's what's possible when you build the right foundation and have the right guidance. Both of them started exactly where you're at right now. Frustrated, inconsistent, knowing exactly what to do, but not able to get the results that you know you're capable of. Here's what happens to most traders. They finish a couple courses like this one, they try to apply what they've learned on their own, and yes, it's possible to figure it out eventually, but without structured guidance, accountability, and feedback, it takes years. Years of trial and error, years of blown accounts, and years of wondering why it's not clicking yet. Time is your most expensive asset, you can't get it back, and here's the mistake I see all the time. People say, I'll wait till I'm profitable, then invest in myself. That's backwards. You don't get the money first, then the skills. You get the skills, then the money comes after. If you're serious about building long-term consistency, click the link in the description and book a call to speak with me directly. We'll break down what's holding you back and exactly what to do next. Like and subscribe if this course was helpful. Much more coming on our channel to help traders like yourself.